So we're just about 1 minute to 11 o'clock. I can see a lot of people just checking in just now. So welcome to the first webinar of today. My name's Simon Campbell from London Investment Week. I'm delighted to have Carol Harmer joining me to review the markets from a technical point of view. And just before we go over to Carol, we're going to have a look at the Forex newsletter that we published earlier on this morning by Carol, and she can talk us through it. And then we'll go across to your screens, Carol, and we can carry on from there. But I'm just loading up this page now. Just while we're waiting, I wonder if I could ask everybody in the room to use the chat box as we normally do, just to confirm that you are hearing me okay. You should be looking also at a slide with Carol there on the screen. If you could just use the Y in the message box, that just lets me know that I'm great, thank you, wonderful.
Perfect.
Sometimes there's a loose connection and I can be waffling away for a good 5 or 10 minutes without anybody hearing me. But
me too, Simon. Me too.
Sometimes it's an improvement, perhaps. Okay, so I'm just bringing up what you sent me through this morning, Carol. My goodness, you were up early.
Yes, sadly. I saw a little slide come across. Oh, hello. There it is.
So here we are. Now, I did this very quickly, so I didn't format the text very well, I'm afraid, but there's the chart that you posted. Now, this was, what time was this? Maybe about 5 o'clock?
Yeah, it might have been a little bit earlier, actually.
Okay, so what are we looking at here?
You're looking at a daily chart of the cable, sterling against the dollar.
Okay, so do you want to talk us through?
For sure. Yes, and I've got it, in fact, funnily enough, on my screen. So obviously we're all going to be looking at cable and FTSE today. Right. You can see there that...
Okay, would you prefer me just to screen share so we can see what go across to your screen? Yeah.
For sure. And then they can take their time to read that, you know, when and if.
Sure. That's on the London Investment Week website.
There we go. Okay, it is showing me that it's showing my screen. Can you see it?
Yes, I can see the screen now. Yeah, we're looking at the FTSE, the spot cable.
Yeah, we're not going to be looking. That's different. We're not going to be looking at that one yet. There we go. You let me know when we're going to get started, Simon.
I think we're good to go now. We're just over 11 o'clock, and we've got people still coming into the room. So we'll just get started now, Carol, if that's all right for everybody that is here on time, which is great. So thank you everybody for joining us. Carol, I'll hand over to you to start with the analysis of the charts, and just to clarify, always being asked about the recordings. They are being recorded. We have a recording already of yesterday's sessions, which I'll post in the chat box for you today. And these rest sessions themselves are being recorded, so no need to worry about missing out. So Carol Harmer from Charmer Trading Academy, over to you.
Hi, good morning, everybody. What a day to get started, eh? When everybody feels that the end of the world is nigh for sterling. Well, let me take you back a little bit. Look at where we've come from in 2008. Okay, so look at where we come from. We come from above 2.100. We come all the way down. So came all the way down to 135, and then for 2 years we did nothing. 4 years we did nothing at all. Now that could be construed as a continuation pattern. If we look at where sterling came from when I started trading, it was well above here. It was like 270. Get it on. I did have it on earlier, but I can't seem to get it on at the moment. But please take it from me, we have come from greater highs than we saw here. So let me see if I can do that. And I can. Okay. So funnily enough, this was when I started trading. Okay. When all the central banks were getting together to drive the currency lower. Okay. So you can see that here we haven't really fallen out of bed. We've got support around the 103 area from May 1985. So let's just get everything that is going on at the moment into perspective, because really it isn't as dire as what people are saying. So let's go on to the monthly chart. Now, if we go back a little bit further, just take that out. See where I've drawn these two trend lines in? There are two because, you know, sometimes you take one that looks the obvious one and then you try and see if there's anything else that you can see in the market. Now, if you look at this pattern here, this continuation pattern, the measured target from this pattern is quite dire. We're talking about it going down to around this level here. Now, we're still higher than what we were in 1985. And please believe me when I tell you that the end of the world didn't happen in 1985. We got on with our life. It's all right, it's only water, don't worry. We got on with our life quite happily. And, you know, life didn't change really. But look at where we've held. Okay, we have a trend line coming in at 127.40. The low is 127.37. This isn't spookiness. This is where people look at longer term charts to gauge where a market should stop, because, you know, although people are always aware of the fundamentals, you really need to know where the big guns are going to come in and support sterling. Now, looking at that chart, yes, we could be supported around here. However, this pattern tells a different story. If I take this out to a weekly pattern, it again tells a better story. So we'll just put that in at 500 and give you a better idea. Actually, we'll do that. So, you see where we entered Brexit. Now look at this pattern here. You had lower highs and higher lows. Now this is what we call a continuation pattern. Now if you measured how we do measure in technical trading where the market should end up, this is quite scary, but if you measure this bit from 135 down to 127.95, you can see that we're going to come in around about the 120.5 area. I could ask if everybody could see that, but obviously you can't. You've got to go through Simon. Now these patterns they're not tricky to see. Look how they formed. Okay, what it is that the market pauses for breath. So after that big move out of Brexit, it came along and it's a continuation pattern. It's run up that mountain, pause for breath halfway, take your drink, take your sandwich, and off you go again. Now, when markets get completely oversold, they need to correct. So whatever happened down here, we know what happened down here. It hit a previous low. Whatever happened down here made the market get overextended on the side, and all we've done is correct that oversold scenario. Now look at where we've turned on the weekly charts from. These are quite important because they give you the actual turn. Now, we normally use an 80 to 20 ratio with overbought, oversold levels. And these weekly charts turn bearish from neutral. They turn bearish from the midpoint at 50. You can see that there. See? And that's where we turned bearish. That was your key that all was not right and it wasn't the start of a bullish phase. Well, you could see that anyway, because these continuation patterns aren't bullish. They are what they say. They are a continuation of what's gone on previously. So if you look at what happened in 2014 when we topped out, you can see that there. Okay? All we've been doing is going in a downtrend. Yes, we accelerated on Brexit. There's no question, and I worked through that night. Trust me, we watched every single movement that cable did. Yes, we did that, but we still got overextended on the downside. But there is room to trade lower. There's a lot of room to trade lower because this is only the minimum measured target. So that's 739 points. That takes that down. If you take that off of the 27.95, it's 120.5. Now that still isn't at its lows and it still isn't the measured target of this. It's only this bit that we're interested in. Now, I'm not the only one that does this. Please believe me. There are teams around the world. You would be amazed at how many central banks, I have to say the BOE have been absent, but how many central banks use chart points to go in and out. So this isn't something new. It really isn't. It is something that has been building for a very, very long time. Now, does anybody have any questions before I witter on? Because it's very nice to get, people are interactive.
Just maybe a housekeeping question first. Just had a question saying, is there any sound? I'm hearing you fine, and I'm presuming everybody else is hearing you fine, but could we just go through somebody give me an indication of that you are hearing us okay, if you could. Oh, great. Oh, well, the overwhelming majority are hearing us fine. That's, I'll go back to this particular person.
Good, because I really not want to do that all over again.
No, because that was it. That was your chance. And that's the secret of making money in the markets. Tozine is asking, we're looking at the pound dollar already. There's just a request later if we can go and look at the pound versus the Australian dollar, the dollar Canadian, and the euro yen. So I'm sure you're already thinking that we can go and have a look at these, but that's a request.
Well, I have. Obviously, the sterling crosses have come up on your radar for sure. Euro yen isn't something that I actively trade. I keep my eyes in it, but I'm quite happy to go through it. What was the other one? Dollar CAD, love it. So absolutely fine to do that. Yes, okay. But the flavour of the month at the moment, guys, is cable.
Sticking with cable then now, Ripple is asking, so when would you get short of cable? When it breaks the trend line?
You can get short. See, if you look at these, what is difficult is to put how the market works over to the retail trader, because unfortunately, they don't have the resources behind them to actually sell it at where they should and hold it at where they should. Do you see what I mean? They don't have the backing, if you like, of being an investment bank, being a hedge fund, working in a bank. So it's difficult to say. There are two ways to play this. You either sell on the back on a retracement to the break point, which is around about 129.10, or you sell a break of 127.25. At the moment, there is no low enough that you can't sell. Do you see what I mean? The weekly charts do show that we're going to still continue to go down. So even if we bounce back up to the breakpoint of today, that doesn't mean to say everybody's going to get really, really excited about sterling. They've got it in their mind, it's going lower. Now, if you look at the fundamentals as well, they tie in with it as well. Because I don't know about most people, but I remember the ERM crisis when Norman Lamont came out and said, we will stay in this. And all at the banks, all we did was sell sterling. You know, it's an easy target. Do you know what I mean? Because it's in the market already that this is going lower. So it's an easy one to sell. And you'll find that hedge funds and banks have already been positioning themselves in this bit here. Okay. They've already done it. So they're quite happy. They're not going to start taking profits yet because we've only just broken. So they're going to start taking profits maybe at the first trend line, which is at 125.45. The next one is at 124.40. But the big one they're going to have in their head is the round figuritis at 120.56, which ties in with the measured target of our continuation pattern. And also, I have to say, our Bank of England did send a signal to the market to sell sterling by lowering rates. They didn't do that in the ERM. As sterling fell, he hiked rates to defend the currency. I haven't seen any of that this time. I haven't seen the Bank of England come in for a good few years now. Maybe the ERM burnt them beyond what they could do, but I haven't seen them come in. So that tells me that they're not unhappy that the currency could go into freefall to 120.5.
Jeff's asking, do you have any time scale for that level 120.5?
Yes, you do. What you do is you measure how long this took to form. Okay, so we know it was from June till now. So let's just say 3 months. So it should reach its target no later than 8 weeks' time, because you just go over the halfway mark on it. So that's how you can get the timing with the target. Do you understand what I mean? Because you can measure not only price and targets, you can measure the time it's going to take to do it. Now, the bigger monthly picture of that huge continuation pattern that formed over years and years, obviously you halve that as well. So it'll be very nice if it all tied in together. But between 6 to 8 weeks is where we should expect sterling to reach its downside target.
Okay. What about, we have a question on the MACD. Can you explain how you interpret the MACD?
I like its little pretty pictures. The MACD is an oscillating histogram, okay? And the plan is that if we turn, you look at how it follows the stochastics, because your stochastics are going to tell you first, okay? They're going to tell you something's wrong. And if you look at the stochastics, we topped here on Brexit, we didn't top on this. So it sent another signal to the market that we were going lower. But look, we were still in a bullish sort of vein until we got to here on the MACD. So it's nice to look at pretty pictures, but I don't take too much notice of this one. It just gives me a general overview of what it's looking for and what it's. These are the two that I use constantly. This just confirms, but sometimes it can confirm when the move's already happened. You see? You see how these went lower first, and that didn't. It was still showing to go up as we turned, as we come down. It's only when you got to the bottom that it said, ah, right, okay, we're entering a negative phase. In actual fact, we didn't. We went sideways in this continuation pattern. So try not to get too involved with the MACD. Try more to look at the stochastics, of which you put in your own parameters of 1033.
What
Was that a
about?
bell for me, Simon?
Sorry, no, that wasn't last orders.
I was just going to say, get off the line.
What about? David's asking a question about on the fundamentals. I suppose looking forward, we've got the U.S. elections as well. How could that affect the dollar?
Are you talking about against sterling? I mean, there are fundamental reasons why sterling
Yeah.
should go lower as well. You know, you've got the trade contracts that need to be sorted out before we exit Brexit. Now, as everybody is aware, the lower the currency, the more leeway you've got to negotiate with the rest of Europe. So it's not only technicals, it's fundamentals. As for the dollar, with the election coming up, I mean, it's a bit like, who'd you pick, Ronnie or Reggie Cray? You know, of course it will have an effect on the dollar, and it will have more of an effect on the stock market, who has come off its highs and is not looking that happy at the moment. And what you've got to imagine is, you know, with FTSE and the S&P, they went their separate ways. The S&P broke its all-time highs a few months, weeks ago, in the summer. It broke its all-time highs of 21.34 and actually double topped at 21.93, and has come down and is like looking a bit sorry for itself, and will continue to look sorry for itself unless we break above that 21.78.84 area, which we're not doing. We seem to be a bit flat on that one. But it will affect it, of course, and I think this is why it's quiet, because they're not sure which way to leap. Because there's not, I mean, I don't really get involved, but as an outsider, I'm looking at Clinton and Trump and going, eek, whoever put them forward really sort of needed a bit more thought going into it, I feel.
It seems to be like, doesn't it? How they can end up with two where nobody seems to be happy with either of the
Correct.
candidates.
And it really has been like a comedy of errors, hasn't it? You know, it's been like, I mean, Donald Trump with his finger poised over the button. Really? No.
Yeah,
much too volatile. And Hillary Clinton is much too sad, really.
well,
So
we'll just have to sit back and watch it from over here. If you are over here, there's people obviously on these webinars from all parts, so it'll be interesting.
And what do they think? You know, I mean, if you look at the dollar as a whole, it has been relatively sidelined. If you look at the dollar index, we haven't really done a lot with the dollar. It's been more the intermarket spreads that have moved the market, and the dollar just seems to be, eek, let's sit back and wait and see, because you're seeing that in the Nasdaq, you're seeing that in the T-bond, you're seeing it in the note, you're seeing it in the S&P and the Dow. They're all a bit wait and see what happens.
Is there a relationship between the value of sterling going lower and the institutional investors looking at the value of the stock market? With the pound being lowered, do banks look at that and think, well, hang on, these shares are better value now because the pound, the actual currency that they're trading in.
Oh, for sure. Oh, yeah, for sure. I mean, investment banks. Every bank I've worked for, we have an investment side of it. You know, so we had this conversation a lot, as you can imagine, in the 80s, because they have a portfolio, and within that portfolio, they have to be in certain markets. You know, it is divided up that you can't just put all your money in currencies. You've got to be hedged, I suppose, is the word, diversification. So, of course, they will. They'll go, well, stock market's going up, but hang on a minute, it's not worth as much now because our currency's devalued. So it swings and roundabouts, isn't it? What you gain on one, you take away on the other.
What about?
They do look at that. They do look at that quite strongly.
There's definitely a relationship.
For sure.
As cable goes lower, is there a likewise a a, a reflection on the euro pound? Would you expect that to go higher at the same
Yeah,
time? Hmm.
I mean, let's have a look. Oh, well, I know, but I'd like you to have a look. And, you know, I always look at the longer term charts first. And you can see quite clearly, you know, there's where you based. Now, this was last year. You see that inverse head and shoulder pattern there? You can see it. Can everybody see that? There's the shoulder, there's the head, there's the shoulder, there's the neckline, there is the measured target. Now, obviously, we exceeded it. We did hold it for a very short time. We came back down. We never broke the neckline, and up we go again. And, you know, we've had big moves up since June in the euro sterling. You can see there doesn't seem to be a top until you get to here, which is 88.06, well, roughly. Let's say 88.10, you know, I don't want to be picky, of the 2013 highs. If you look at what happened on a monthly chart, there's your scope. We all lived through the crisis in Europe, and most of us expats, when I was living abroad, you were getting 1 for 1 and even less. So look at the scope of where it can go. There isn't really any top unless we cannot break this. Now, if we can't break above 88.10, it will come back and correct. Yes, we're overbought, but in a trendy market, that doesn't matter. Can you see what I mean? People have goals to go for, and euro really wasn't loved, was it, in this period of its little life? You know, everybody loved it here. Then it died, and Europe has been the one. I mean, by living down here, what you look at is, are they building? Are the things that have been empty and desolate for the last 8 years, is it beginning to move? And we did see this last year. We saw it, and that coincided with the euro getting stronger against the pound. And we go above 88, it will continue to do so. You know, it will try for this level up here. It's a natural level for it to try for. Will it get back to parity? I don't know. There's nothing in that chart that says it won't. But obviously it's a game of wait and see. 88.10 is going to be the key level on this. You're going to find a lot of people not only going in short, but covering long positions, because imagine being a hedge fund on a break above here. There's been absolutely no reason to cover it, has there? You've had a straight run up to this that is a glaringly obvious source of resistance. So you might say, well, you probably will see profit taking. That doesn't mean to say we're going to enter a huge bear market. It means that the market is due for a correction. But as long as the correction holds above here, which it did before, then you're quite safe to go long. And on that attempt, it should break it and carry on higher.
Mm-hmm. Carol, can you just explain it to
abroad, I have to tell you. I wish I could say something better that it was going to puke out of sight. Sadly, I can't see it.
When you talk about, on a sort of technical point of view, when you talk about people going short but covering long positions, can you just explain what that means as a retail trader, what it means you're doing and how you would do that?
Do you know what? And I must just say something. This is why, your question is why I started up the Trading Academy. Because I got sick of 90% retail traders failing. And one of the reasons they do is that they don't understand what's behind the thing they trade. You know, if you ask most new retail traders, you know, no disrespect at all, but they don't know what runs the market. They probably didn't know that the euro sterling topped out at parity back in 2008. And that's why I want to do that. I want to show them how to trade like a professional trader, with the mindset of a professional trader.
Mm-hmm.
And I think that's a really good thing to do. You know, I'm getting to the, I say the end of my trading career. Well, that'll be 40 years, Simon. So I want to spend this next 5 years, because if somebody like me, who does talk to retail traders daily, say I was to walk out and get hit by a bus, I would like them to be able to trade for themselves. This parrot fashion of trade copying and following trades really doesn't get you very far in the long run. You've got to understand what you're doing. Now, why would they be covering longs? Because they've bought down in this area here, okay? And they've took a big chunk of profit out of the market. Now, they see this level here as a stopping point. So instead of wasting 5 big figures of profit, they would like to take profit on their already long position here. Now, sellers who have been basically slaughtered in this last year want to come in at this level because it's an obvious level to sell. Can you see that?
Mm-hmm.
You know, you always have to look at significant periods of time, and this was a significant period of time just before it absolutely puked, went lower. So here is where the market is going to come under pressure. So they don't want to see all that taken away. And don't forget, with hedge funds and with institutions, there is that always, I can go back in on a break. Because once you've locked in half the profit, and I do that when I trade, you know, I'm always locking in half the profit. I feel like, who was that woman? Anne Whitcomb. And who did that when they used to go bank. They used to bank the money. And that's what they need to do here. So they're not going to let it run away with them down here. They're going to logically take profits where the rest of who trades the euro sterling are taking profits. You know, it isn't the retail market that moves this. It is institutions, banks, and hedge funds. You know, people with the clout to do it. So that's all that means when I say they're going to be covering longs. What they've already bought, they're going to start taking profits on it.
Excellent, thank you.
And the eternal bear is going to come in and try and whack it, because it's a good level to do that too.
Now we've got a few questions. I'm just trying to
I thought you might have.
organize the questions between. Some of them are technical. Let's just try and stay on cable for the moment.
On cable, you want me to go back?
There we are. Ray saying, do you have a good technique after entering a trade of keeping you in the trade to maximum profit?
Yes.
Do you have a good technique after entering a trade of keeping you in the trade to maximize profit?
Yes. What you do when you trade is, as you go into a trade, you always have your stop loss and you take profit order. Okay? And if that is reached, it doesn't matter if the market goes further a little bit. Like, for example, we took profits down our dollar CAD position at 31.60, and we were long at 30.75 from yesterday. So yesterday was a bit of a, went up a little bit, come down a little bit, didn't really do much, but the underlying was that the dollar CAD was going to go higher, so we positioned ourselves that way. Now, I had that target in my mind of 31.60 because this is my job. This is what I've done for 34 years, you know, in various, well, actually it's not various banks, I've only done it in 3 banks and the life floor twice. Once when I worked for a company, I worked for Midland Bank on the floor trading, not order filling, I was always a trader. So I worked for Midland Bank on the floor trading the treasury bonds. That was deep and joyful at the time. But in the banks, you do have this profit expectation of where you think it's going to go, and you can always go back in. There's nothing worse than having a target in your head, not doing it, and watching it come back to break even. That really upsets me. The other way that I like to do it is to cover half, run half. Okay, so if you're really looking for some big moves, that is what you can do, because you can always go back in. As long as you know your primary, secondary and minor trends and where your levels are, it's always about the levels and the trends. You can do that, but you must have a target. Otherwise, you're just going to be, what most do is 10 points profit, 10 points profit, 10 points profit, 80 loss. You can't do that in this business anymore. Well, you can't do it in this business, full stop. You've got to be able to, when you go into a trade, what is your expectation, and wait for it. Patience is a virtue in this business. And I know people tell me that it was a very fast business, but we're not in the position of scalping. I would hope that the majority of retail traders want to learn how to trade, and scalping isn't trading. It's crossing your fingers, buying at 5, hoping it gets to 10. If it gets to 3, you're not happy. Do you see what I mean? It's a totally different mindset, and a lot of the time it's a bit of a headless chicken race. So what you need to do is stand back from the noise and look at the markets you're trading. And once you can do that, you can maximize your profit potential. I make it sound easy. I think after 34 years, it comes a second nature to me. It's the people that are starting off. Personally, I don't know how they can do it, just being on their own, sitting in the screen and having all this stuff fed to them. I think my background of learning when the life floor opened and then going back and starting up technical trading departments at Midland Bank, Nomura and Credit Suisse give me a really good groundwork. Do you know what I mean? I learned, one, I had to teach myself because nobody understood about technical trading, but 2, it was a fantastic environment to be in. But you know what, even after all that experience, when I gave up being a bank trader and leased a seat on the life market in 1996, when I went in that pit for the first time in 11 years and it was my money on the line, your legs go. And don't forget, when you're trading on the futures floor, to buy a Bund contract was like £100,000 or £1 million. It was quite expensive, but I'd been a bank trader for all those years and I wanted to do it myself, you know. But even me, after all that experience going back on the floor, I was so nervous that first trade. But after that first trade, your training kicks in, and this is what I think to the majority of retail traders. Don't get me wrong, you're going to go online and you're going to find people running courses and they're going to say they've done this and they've done that, but you know what, if you haven't worked in a bank dealing room doing technical trading, you can't teach it. It's that simple. If you haven't worked on the floor trading futures for yourself, you can't teach it. It's that simple. Sorry for the millions out there online. And if people say they've traded for 10 years, it's not enough. You've got to be able to have seen markets, bull markets, bear markets, work through crashes, to be able to impart this knowledge on what is a great business, I think, the retail traders, and it's going to carry on. Far after I'm dead and gone, it will carry on, because to open it up to the general public was a really good thing, but no training was given, and that's my issue. Soapbox over.
Soapbox over. No, thank you. What is, then, Ripple's asking, what's the best tip that you can give a retail trader to think like an institutional trader? What do you think perhaps is the one thing that holds them back?
Okay, when I can only go by what I did. When I first started, as was pointed out to me, there was no back data. Okay, so I started, people hadn't really heard of charts over in the UK. They just hadn't. You know, maybe some had filtered through but was ignored. The US, yeah, when I went to work in New York and Chicago, of course, they were all very up on charts. But what I did when I first went back is I went back to the archives and I plotted what the price had done for the last 10 years. So I went back, when I was doing it in the 80s, I went back to the 70s. Do you see what I mean? And I think the retail trader is too eager to just get in there and do something. I find a lot of the retail traders that I deal with feel they have to be trading 20 times a day. You don't. You need 3 good trades a week. That's it. You don't need to keep pressing that button, because all you're doing, if you're in and out, in and out, in and out, you're not seeing the bigger picture. You're sitting there looking at, and it's come up from 70. Oh my God, 75 is a good level to sell. No. How about 80? Nope. How about 85? No, not so much. Can you see what I mean? Once the market trends, you have to be experienced enough to go with it, not to keep finding a top or a bottom, which is what I find they do. You know, and the other thing that comes out is, well, if you wanted to buy sterling, and this was a question I have been asked today, but you wanted to buy sterling yesterday at 129.10. Absolutely right, I did. But the stock was tight, and what I should have done and didn't, even experienced traders miss out, is reverse it. But I was waiting for it to pull back, where the reason I didn't want to buy it down at 128.5 was the fact that I went into the trade for a reason. It was holding quite a significant trend line. So as it had bounced off there 6-7 times, it was right to do it. But in your head, you're like, well, I'm not going to take much out of this market because it's going to go down. And that is exactly what it did. So as soon as that broke that trend line, I'm out. Why didn't I want to buy it at 128.50? Because it was cheaper than 129.10. It's because the reason for going into the trade was no more. It hadn't held that trend line, which is something I had looked at for the past X amount of months. It didn't hold it. You want to be short.
What time range? So that's a good lesson, that the retail traders often make the mistake of looking too short term, and
yes.
they should be pulling back and looking at a longer term and trying to discern trends, slightly longer term trends.
1,000%. But they don't, and they feel that they've got to be in the market all day long. You don't. I've seen really, really good traders blow up their accounts, professional traders, I'm not talking about retail, blow up their accounts for that reason only. 1, they don't sit back. 2, they're not patient. 3, they've got no idea of what is trending and what isn't. And, you know, if you're going to be focused on one market, look at it, go back in time, know where it's going, what patterns it's made. In your head, what is the market expecting out of this? Now, it's easy for me. I've been in the market, I've been in the herd, I've been in the pit, I've been on the market with this 4,000 people. I've been in dealing rooms where there's been 300, 400, 500 dealers. So for me, I just sit back at my desk on my own, but in my head, I visualize what they would be doing. Worked with hedge funds, worked with investment bank, with the investment side of the banks I worked with. And the retail market hasn't had, 1, has not had that opportunity to have that experience, and 2, basically they haven't had the training to be able to cope with it. So many people wanted to buy sterling yesterday, and it was just like, no, you can't. It's going to go lower. It's going to hit that long-term trend line at 127.37, you know. It's going down because of the pattern it's made and the projected targets it's had. I'm not alone in thinking this. You know, I've dealt with central banks. You would be amazed how often they would ring at strategic times and says, is there any significant support and resistances around here? Yes, I'd say. Then I'd toddle over to the relevant desk and go, I wouldn't be long here. They'd go, okay. You know, you've got to get into your mindset. It's so psychological, this market. And unless you learn that and understand that very, very quickly, you have got no choice but to get caught out more times than what you're going to be winning. And that's the sad fact of life, unfortunately.
So what time frame? Where can we realistically see a time frame as a what's the difference between a long term and a medium term time frame? Would you
Well,
say weeks or months?
if you ask who's on there, what is the market that they trade most, I can tell you. You know, every Sunday. Now, as I say, I am an experienced trader and technical trader. You know, I've had no option to be fed with fundamentals because when I first started trading, there was no charts. So I got given all these fundamental things to learn, and every single piece of it, without fail, was bearish for the bond market. Every bit that came out. Do you know what? It went up. Now, I was very new, but I sat there for 8 months thinking, my brain wouldn't understand this. Get in that pit and sell the bonds. Off I'd go and sell the bonds, they go up. And I'm like, well, whatever you're looking at is wrong, until I discovered charts. Whatever market you're trading, you have to know your primary, secondary, and minor trends. So every Sunday, even me, I go through all the weekly charts, all the monthly charts, and I take my levels. I do my weekly pivot points, and then I scale it down to a daily. Then I scale it down to a 4-hourly. You know, the shortest term I ever do is 60 minutes. Shortest thing I ever go through. But every week, without fail, I go through them charts. And I know I'm back to front, but I still do it. And nobody puts the homework in. You know, how many work 18 hours a day, 6 days a week? I'm just saying. You've got to put the time in to get out of it, to get the most out of it. It's not a one-way ticket to being a millionaire in 3 months. It doesn't work like that. You've got to put the groundwork in. You've got to understand what you're doing. And whatever market you're trading, think outside the box. What is the real market doing? Can you understand that?
Yes.
Cool. Can everybody else understand that, or is it just me and you?
I think so. No, we're making great progress. What about moving averages? Ray's asking about, do you use moving averages to keep you in a trade?
No, that was a black box system that we used to use in the 80s. By the time the averages tell you to get into a trade, it's already happened. Okay, so the golden cross and the da-da-da. The only one I really would look at would be the 200-day moving average. The rest of them, no, not so much. What you can use them for is support and resistances. Or what happened, I mean, we only used to have simple ones, so it was quite simple, really. 9, 18-day, 55, 100, 200. Happy days. There's all these different takes on moving averages now. There's the smooth DMA, there's the not smooth DMA, there's the this, there's that. It's so confusing. And my theory, no, it's not a theory. My working life has been geared round, keep it simple, stupid. So the trend following things that we did in the 80s, you don't really want to be doing now. If you want to follow a trend following model, just look at the chart. It will tell you everything you need to know. Put your Fibonacci's on, look at your stochastics, check the RSI. What's the monthly doing? What's the weekly doing? How do I tie that in to what it's going to do day to day? Yeah, how much information can you get out of that one market? And it takes time, Simon. It takes a lot of time, and it takes, for me, still a lot of effort.
Jess asked if you've written any books.
Do you know what? I don't have time. But I am. I mean, I am doing my. Do you remember when we did the London Olympia show?
Yes.
Okay. So that was my first taste of the retail market, and you know, I thought it was really good, especially when all stood up and clapped. I thought that was really, really good, and that gave me the confidence. I've been asked so many times to write a book. The thing is, the way I do it is the way I do it. It's not something you can. If you've got a book of Fibonacci's and read through it, I don't do it like that. So it's very difficult for me to write a book on, say, Fibonacci's, because the way that the Fibonacci sequence is stated, it's not quite how I use it. I've caroled it, if you like. So it's all in my head. Now, what I have done for the... So there you go. I've got a little taste of the retail market, and I have a brilliant group of retail traders that work with me. Absolutely brilliant. We keep it small. It's only us. This isn't to flog it to you because it's a closed group. But what I have done is, because there was such a request for knowledge, I've written a course, and I'm really excited about it because it's funny, and it's me. As I'm reading through what I've already written, it is me. So I don't want to publish it because I don't know. I just don't feel like I want to do that at the moment. But this is what I'm teaching at this 4-day, 5-night academy thing, where you come into my home, we go through silly little cartoons, but it's very full of carolisms that I've got over the last 34 years. Maybe one day I will publish it, but at the moment I don't have the time because it took months to write it. You know, I wrote it in 1996 and put it to bed, just give out copies, you know, when and if, and I've had to update it for this particular course, which I've got 3 sold out, and I start Sunday, a bit nervous, but maybe it will be turned into a book one day. Who knows?
I think it'd be fantastic. I know.
Yeah. Do you think the life floor traders will all be quaking in their boots? Oh my God!
I'm sure they will. They'll think, "Oh, Carol must have a course on." We talked about this last time. I know you've sold out the first few events, which is fantastic.
I haven't advertised them yet. It's been word of mouth, which has been fantastic.
Oh, that's good. Well, I've put the link to your website in the chat box there, so people can get in touch with you and maybe find out if you're doing more in the new year.
It is, because that is something. I mean, don't forget, my first love is trading. You know, I wouldn't get up silly o'clock on them. I mean, so 2 o'clock this morning. You know, you've got to want this. You've got to. After 34 years, I am as passionate, if not more, today than I was back then, because I know so much more now. And I go back and think, oh, if I'd have known that then, blah blah blah. But because I know it, and I know that I'm limited in the amount of time I'm going to be able to put in the hours that I'm putting in. So it's like I want to leave a legacy. It sounds a bit pretentious, and I'm not at all, as you know, because you've met me. So I'm not one sort of wave the flag and go, you've got to read this. But I know so much more now, and I want to help because there isn't the help out there. And if it is out there, it's possibly not the right help out there. Do you know
well, that's what comes through. Yeah, I mean, we've met a few times and obviously talked on the webinar.
Never changed, have I, Simon?
Never changed. No, but it's what comes through is I can sense a level of frustration, having I think worked on the inside of the banks and the floors.
It is.
And then now being a private trader yourself, now you can sympathise, you can empathise and see the challenges and struggles that
absolutely.
Without that, I mean, the benefit of all that insight.
I would not be the trader I am if I didn't have the background I had. I wouldn't. I couldn't do what these guys do now because, oh my God, you know, you are bombarded with a lot of noise and you've got to strip it out and take stock. You know, 90% fail, that's too bad. That's not fair. And you don't have to. No, my guys aren't failing. They're not.
Can we? I'm just noticed the time. We've got about just 6-7 minutes to go. Could I ask you quickly if we could look at gold? We're getting a few requests.
Very interesting. Yeah, we got a bit carried away on cable, didn't we? Okay, so first we're going to have a look at the weekly chart. Now, if you look at this bit here, that's this bit here, okay? Now this is a bullish pennant. It's a sequence of higher lower highs and lower lows after a sharp move up. Well, we did have a sharp move up, okay, and we accelerated away. So again, it's a pause for breath. Continuation patterns take many forms. This is what we're seeing now, but because it's sloping downwards, the 1310 area has now become 1304 to 1300 with stops placed. I think sorry, it seems like, can you get that? Seems like the dog is having a hissy fit. Okay, so someone's come up the lane. He doesn't like it. Doesn't like strangers. So here is where you're going to see people buying gold. Look at your stochastics. Okay, the wicks are just hovering over the overbought, oversold level. Now they're flat because we've been flat, but they're at the lower end of the scale. So tie these in. This is pointing lower, but it's not. You know, it will do as the market drifts lower. And that's what we've done. Look, we've drifted lower. We've made a new low every time. It is a bullish pennant. The only time it's not going to be bullish is if we break it. Now, short-term traders, you know that everybody's going to have their stops at 12.95. I know where the stops are because I just know where the stops are. So what you try and do is you don't want to get stopped out at the low. You want to put your stops that little bit further. So if it means that you take a shorter, a cheaper position, don't put all your eggs in one basket, you can scale in. Do you understand what I mean? So here's where you want to be buying. You don't want to be stopped out at 95, but you don't want it to go below here. If it does, this is null and void, and it's going to create a topping pattern. But at the moment, we're still in the continuation pattern, and it's still in a buy dip scenario. But don't get caught out, because the Middle East have been buying this big time, and they will unload it if it starts going below here. See, another thing that maybe I shouldn't have said that. It's only that I know them that's doing it, so I know what they're doing. So. Any other questions? Oh, and if you put that onto a monthly chart, you take that high to there. See where we just couldn't break that 38.2% fib. Now you wouldn't have got that from any other chart but the monthly. So this had to correct. Okay? As we used to say back in the day, it was rude not to. But unless you look at these longer term charts, guys, you're going to see that as an uptrend. You look at the overall picture. Primary up, secondary down. Be careful. Okay. Well, it was up here really. So this is the level we're watching. Did that make sense? Did everybody understand that? So what I'm having to do is I'm having to cram in things in a very, very short space of time. So I'm assuming that you all know the fundamentals of technical trading. If you don't, I'm really, really sorry.
Okay. A couple of random questions from Ripple. How long typically does an institutional keep a trade open? Is there any typical length for an institutional trade?
Depends on what their targets are. Depends on how long it takes to get to its target. No, hold it forever.
And the software you're using, we're just in the last minute now, just a couple of questions up. Pro Real Time, is that something?
Yes, I use Pro Real Time because it projects well. My system that I use for all my analysis is not pretty. It's accurate, but it's not pretty. This is pretty. I can pretty this up. But this is my problem, is I've got different systems. This isn't quite as accurate as it should be. So I use my not pretty system to actually give me the data and do all my analysis on before I take a trade.
Okay.
I don't use that one.
there's more questions still, but we put the website there. If anybody wants to get in touch with Carol, you can do that through her website, charmertradingacademy.com. But
And you
Carol,
can also contact me on charmertradingacademy@gmail.com. If you want to talk to me direct and not go through the website, that's fine.
Academy.
Don't inundate me at 5 o'clock in the morning.
Well, I think you'll be up. I got my emails this morning from you very, very early.
Simon, I'm always up at 5 o'clock in the morning. I was up at 2 this morning. That's just what I'm saying. You've got to want to be hungry. You've got to love this business. If you don't love it, you're not going to get up at 5 o'clock in the morning, are you?
Absolutely, absolutely not. Well, Carol, we were going to let you go. I think the dog probably needs you now more than we do, so please, I just extend my thanks to you on behalf of us all. You've given us a super hour. Again, it's always insight. I think everybody always learns something when you come on.
I do try.
You do indeed, and you can see the light bulbs going on, which is great. So I've really enjoyed it. Thank you.
Do you know what? That is one of my little cartoons. The light bulb for me. I swear to God, when I looked at this chart the very first time, and I've been inundated with duff fundamentals, and this guy showed me the chart of the bonds, and it was like a million light bulbs went off in my head, and I never looked back. And every time someone told me about M1 figure, I went, I don't want to know about it. Go away. Don't talk to me about it. And that was it. I made my own style. I learnt myself because there was no books. I learnt my own self. And, you know,
great.
I hope that people would learn themselves too.
We're a lot brighter now than we were an hour ago. So thank you very much indeed. I'll take the presenter role back, and hopefully we can have you on again, Carol. We'll keep in touch. And
sure, as long as I'm not boring people to death.
I don't think there's a chance of that. So good luck with the first residential school as well.
Thank you. Will do.
Okay. Bye for now.
Bye, Simon. Bye, guys. Thanks for listening.
Yeah. So my thank you to Carol again for joining us, giving us a little insight to the technical analysis of these markets. Now we're moving straight on as we are at 12 o'clock. Our next speaker is Martin Walker, someone who, for the first time, taking part in the events, the webinars that we host. And I can see that Martin's already here in the room. High probability Forex trading. Let's go across to Martin, bring him in, and we can have a little chat before going across to his screen as well. So, Martin, I've just made you a panelist, so hopefully you can hear me, and I think your microphone's off now as well. So, can you hear me okay?
I can hear you. Can you hear me?
Wonderful. Yes, that's fantastic. Thank you for joining us.
Great.
Great.
No problem.
Were you there for some of Carol's talk before?
Absolutely, and some of the stuff that she spoke about, it will lead on nicely to what I'm going to talk about today.
Wonderful, wonderful. Well, this is great for us to have you on because obviously we do get a lot of regular attendees, and it's always nice to have someone that hasn't spoken before, of course, coming on, lending us their insight into how they do it. So we've got just under an hour, and I think we'll go across and do the screen share now if you're ready for me to do that.
Yeah, let's go for it, Con.
Forex Trading London, just while we're doing that, I know that you have initially a career in the Navy, and then turned to Forex trading after leaving the services.
Absolutely. So I will touch on that as we go through. That's just my disclaimer I put up. So if you're going to start learning to trade, then please use a demo account to start off with. Essentially, that's what it says. What I want to talk about today is I want to strip everything back to basics. In a way, it says learn high probability trading techniques, but what I really want to do is follow on perhaps what Carol was talking about and start thinking about actually what the charts are telling us. Okay, so if you bear with me, I'm just going to, this is me. I was in the Navy, joined at 16, worked my way through and retired as a commander engineer. I started trading in 2006, moved to Forex in 2008. I was medically retired from the Navy in 2012. During that period of 2008 to 12, I sought mentorship for some excellent traders, sucked their brains dry of everything they knew, and then I ended up running a live trading room for one of my mentors, doing the London session, and then I was asked to be a head trader for a private overseas fund, which I did for just over a year. And now I trade, teach, coach, mentor. Why? Because I'm passionate about it. I love it. And trading is quite a lonely profession, so if you teach it, you actually have interaction with people as well during the day, and I talk and Skype my students and other traders around the world. It's always better to have more pairs of eyes than one looking at the charts. That's my website, forextradinglondon.com. You can go there, and there's some free stuff there. There's a learn section. Please feel free and go and fill your boots. So I was in the Navy. I was brought up on a Thames sailing barge as a child for about 3-4 years. I love sailing and I love surfing. What's the link? It's waves. The market moves, so if you, over time, as you get experience, you learn to see the waves and you realize that things don't go straight up and keep going. They actually correct, as Carol was saying, you know, and if you can read the waves, then you can be good at trading. So I'm primarily a swing trader, and I've got a sizable trading toolbox. Okay, I keep an overview of the fundamentals. So Carol was talking about central banks and the various things they do to move the currencies around. I use a trading plan. That's my strategic plan of all my strategy and why I'm doing it. I look at key supply and demand levels. Okay, and we're going to cover that today. I use fibs. I use price action. The strategies I use is the 1, 2, 3. I use common patterns. I trade those. I use divergence, both regular and hidden. I trade Elliott waves. I trade Wolf waves. I trade harmonic patterns, and I also use pivots and overextension. Okay, what we're going to talk about today, though, really is key supply and demand levels and price action, and sort of doing time frame analysis, looking at various time frames to do your analysis, rather like Carol was saying as well. So if you can overlap all of that, then you can have a higher probability of success. But quite often, I've stripped out my strategies and thought, well, what's really going on here? And what's really going on is actually basically support and resistance, supply and demand, and price action. But strategies are good because they provide a set of rules and framework for the human mind to be able to interact with the charts and moving markets. So they provide structure. But actually, if you strip those all out, actually what it comes down to is key supply and demand levels and price action. So that's what we're going to look at today. Plus, I'm going to throw some candlesticks in as well, and we'll get on to why when we do that. Okay, so let's look at this first one, supply and demand and looking left. Before you cross the road, what do? You either look left, then right, then left again, if you live in certain parts of the world, or you look right, then right again. Why? Because it's in order to stay safe, so you don't get run over. The same applies to trading. So a top trading tip is before you trade, look left. The market has a memory. And Carol was talking about, traders, institutional traders, bank traders, they will put orders at these levels of resistance to support, these key levels. So always look left, and that way you'll stay safe when you're trading. So what is supply and demand? Well, the market moves because of order flow. Okay, so if you have more sell orders than buy orders, price goes down. If you have more buy orders than sell orders, price goes up, rather like a seesaw. And when I say more, I mean in terms of volume and size. If you get areas where there are more sell orders, okay, that's known as a supply zone or supply level. Where there's an area where there are more buy orders, then that's known as a demand zone, okay, or demand level. So supply, if you think about it, is resistance, and demand equal. So if you can identify these levels, then you can see where big institutional traders are actually placing their orders. So let's have a look, see what it looks like on a chart. So what I do is when I'm looking at my charts, and do exactly the same as Carol does on a Sunday evening. I'll look through all my charts, top to down, monthly all the way down to the 1 hour. I look left, and I look for areas where price has fallen away sharply. Okay. Oops, sorry, go back. Just getting my cursor here. Hold on. There we go. Oops. There we go. Here's my cursor. So if you look at these two wicks here, and a really strong bearish candle, price has moved away from that level. Well, that then becomes a supply zone or resistance. And if we come down a level again, it happened here, and then price fell sharply again. We can project that forward to the right-hand side of the chart, and when price comes back up into it, it gets rejected. All right. And again, at the bottom here, price moved, had a wick, price moved up, had a strong green candle here, price came up the top, came back down, found support. And then it found support again, then moved up, and then it came down and broke that support and passed all the way through it. So the more times that one of these levels or zones is tested, the higher the probability that it's going to break down. Okay? And then what happened? Price came down, back into another demand zone. If you look left on my chart here, I've got this strong green candle. Okay, project that area forward, price came down into it, found support, moved away. And this time, this support turned into resistance. The price came back up into resistance, got rejected with a wick here, and then price fell. The second time that we came into this zone here, we broke slightly below it, and then price came back up again. Okay, setting up another demand zone over here to the right. Price moved up, sliced through this one again, second test, back up to where we were before, over here. Could have projected some stuff across to the left here. Back down, found support, then back up into the next one, found some resistance, and then fell down into support, projecting this area because it's moved up, came down, found support, moved away, that becomes support, price then comes up here, back into these wicks here, falls away, and then slices through this level, lots of tests here, eventually comes down to the next level, finds support, a demand zone here, price then moves away. So you can rather think of it like a ladder. You know, price falls, goes up, comes down a bit further, goes up, comes down a bit further, goes up, comes down a bit further, and then it reverses, and the ladder reverses, and the ladder reverses again. And these are the waves of the market. Okay, but by projecting supply and demand zones, by looking left and projecting them right on our chart, we suddenly have areas where we might be interested in fact down here, say buying, if price comes down to here, that could be a buy area. This could be a sell area or a take profit area. This could be a sell area or a take profit area. If I'm selling here, then I could be taking profit down here. Okay, and if you think about it as well, when you buy a house or a car, we want to buy things relatively cheaply. And when we sell them, we want to sell them relatively expensively. Okay, we want to buy things for wholesale prices, and we want to sell them at retail prices. But when people come and trade, novice traders trade, they seem to lose that aspect of being canny with money, and they will chase price. They'll see price moving up strongly, and they'll go long here. Perhaps they'll be okay for a little while, and then the market comes back and takes out their stops. So when you're buying, you've got a demand zone and say, is this relatively cheap? If it's relatively cheap, then that's another tick in the box for you, perhaps to be going along here. Or if you're up here saying, is this relatively expensive? Well, it is. Then there's another tick in the box to perhaps be thinking about trading short. Okay, so you can trade between the levels. Okay, and if you're halfway between a level, then maybe you can then say, okay, well, let's look at price action. Then we can say, well, perhaps we can trade down to the next level if we're halfway between it, depending on price action. So I hope you can see that. So by looking left on your chart, we can see where the market has a memory, and we can see where the institutions place their orders. Now, I like to use sort of dailies and 4-hourly charts really for demand and resistance, supply and demand zones. Can use weekly, can use monthly. But this principle works on all time frames. Okay, so we can trade off the zones and levels, we can trade between them, we can trade to them and away from them. Plus, if we have a good zone, then our stop loss can go beyond the zone. So in effect, if we go back here, whoops, sorry, here, if I'm going long here, then I can put my stop underneath the zone. So I've defined my risk, and my reward is looking to the next zone up here or up here. Okay, and make sure that they are a decent risk to reward ratio. So if we're going to trade off of good supply and demand levels or zones by looking left, then we need to have some confirmation of a turn in price action. Okay, so what would that be? Well, price could close out of the zone in the direction of the intended trade. Price action could confirm the reversal or the turn, and the price could paint a nice rejection candle with a nice wick. So let's look at price action and some common candlestick patterns. That's really what I said before about having price action and candlestick patterns put them together. So let's have a look here. So here I've got a demand zone down here, which I projected from the left, looking left. Price has come back into it. We've made a low, then price has made a high, then price has made a higher low here, and then price moves away. Okay. And then we had a wick penetration into that area, and then price moved away and got rejected there. For instance, I've gone long here, my stop was underneath here, and this second line here is break even, but price then moves up, my stop is underneath here, or could be underneath the low here of the demand zone. It's relatively cheap compared to up here or compared to up here. Okay, price then moves up and then prints another higher high from here, another higher low, then another higher high, then another higher low, and then keeps moving up to make another higher high, and then things start to become relatively expensive. But you can see from price action, if price moves out of a zone, then pulls back to it here, and then moves away, okay, that is a confirmation of a turn, a change in trend. All right, and then we can combine that with candlesticks. Here's one going from a bearish trend, so hit a supply zone resistance, price made a high, got rejected, made a low, came back, made a lower high, okay, and then continued down. All right, so you could go short up here, knowing you've had price action saying, and you're at the supply zone, go short here, stops above the top here or above the lower high, and then looking for targets, looking left, well, here's a good target down here, and maybe over here, projecting those across. But lower lows, lower highs, lower lows, lower highs, downtrend. Okay, so price action is telling you we had a reversal, and it's also saying you've got a continued trend. If that's the case, stay in your trade. Okay. But we are also looking left as well for potential targets. So this would be a good potential target down here to the bottom. So if you're looking to trade long, then you're looking for the low at the demand zone to be followed by a high and then a higher low. Okay, so demand zones over here. Oops, sorry. Demand zones here, looking for the low, then a high, higher low, and then going long. Similarly, to go short, demand zones here, high, low, lower high, go short. Okay, so let's look at some candlesticks which we can combine with supply and demand, price action, okay, to give us a higher probability trade. Common candlestick patterns, this is a doji or a little cross here, so whatever the time period is, all right. It shows you've got equilibrium really in the market. The buyers and the sellers are kind of meeting each other. The market's not really moving, it's taking a rest. Okay, now I like to see these after you've had a strong move up or a strong move down, as a reversal point. If you get them if you can get them, so you've still got prices come up, and you can see perhaps it's going further, and it has these in it, so it's like a consolidation or a break, it's taking a breath, then don't take too much notice of them, but they must be kind of like occurring at a decent supply or demand level. So look left and match the candles up with the supply and demand. Similarly, you can have a rejection candle. This is kind of called a hammer, where you've got a long wick penetrating into the demand zone in this case, right? The reverse of that will be a shooting star where price, so the wick goes right up into a demand zone and then gets rejected. Okay, I prefer these ones, so he's got a bearish body on, and if you go back, a bullish body on it coming out of a demand zone, and this one leaving a supply zone. Okay, it's the wick really that's telling you that things have been rejected. Another form of candle you get is an engulfing candle. So the body of the current candle you're looking at engulfs the previous body. Okay, so this would be coming out of a supply zone, bearish engulfing, coming out of a demand zone, moving up, bullish engulfing candle. And often you can see these in the markets where you get a bullish candle comes into a demand zone here, sorry, supply zone rather, get a wick, candle closes, candle opens here, get a wick straight up here, candle comes back down and starts to paint a bearish body of equal measure. So these are called railway tracks or tweezers. And again, a nice rejection candle if they're occurring at a supply or demand zone. Okay. There's an awful lot more to candlestick trading, okay, but if you can nail those particular ones, then and overlay them with supply and demand and price action, then there are good odds enhancers. Okay? But candlesticks are not the sole reason to take the trade. It's the combination of those three things, all right, irrespective of what strategy you're using, really. Okay, so if you can put those three things together, then you stand a good chance of being able to trade between levels. So here's an example where we've got demand zone, price has made a low, a high, high, low, and then we get a bullish engulfing candle here. And then we get a kind of doji with a longer wick down this side, and then we get another long wick here. So it's really, price is telling you that there are buyers here. Yeah, that's what it's saying to you. So be open when you're looking at the charts to say, well, what is the chart trying to tell me? All right. The clues are in the charts normally. And then price moves up. And then price comes up to here. And we get a bearish engulfing candle here. See that? The body of this one engulfs that one. And this was rather like almost a doji, but not quite. And then price fell away, back down. Price comes down the bottom here, some dojis here, small ones, see them? They're the small bodies, sometimes they're called spinning tops. And then price moves up again. All right, all the way to the top here, get into the supply zone we've marked up in green, and we get a doji here. In a reversal, bearish engulfing candle here, and then price continues down. Okay, so it's the combination of three. Supply and demand zones, looking left on your chart, where are those orders being placed, price action when it comes down into it, yeah. And when you're looking at these supply and demand zones, you're looking for a price to have previously moved away strongly from them, all right. And it's normally the best reaction you get is the first retest of coming back into that area, okay. If it's had 3 or 4 tests in a supply and demand zone, then the likelihood is that at some point it will fail. All right. So, top trading tip, if you can combine price action and candlestick patterns when looking for confirmation of return in the market, and ask yourself, okay, what has price done? What is price doing now? What could price do next? And do I want to get involved? All right. Because when you're trading the hard right edge, so if price is here and nothing to the right here, it's hard. There's no two ways about it. It's not easy. All right? Trading isn't easy. When price comes down here, you're saying, well, what's price done? Well, we've moved down in a downtrend. We've come into a demand zone. We've had a reaction there. Price has moved up, and now we're currently coming back in here, and we might find support here. But what's it going to do next? Well, it could go all the way up to here. Yeah. I'm between two zones. Do I want to get involved? Well, I do if we get some confirmation. All right. And then bang, we do. Enter the trade. Price goes up here. Take profits. And then manage our trade to see if we can squeeze anything further out of the trade. So it's done. What is price doing now? What could price do? And do I want to get involved? And the last point here really is talking about multi-time frame analysis, which Carol mentioned. She does it every Sunday, so it's what I do. So I systematically look through various time frames of different financial instruments and currency pairs, and I look at the monthly, and I note what I see. I literally write down if there's something happening there that's important, I'll write it down. And I might put some trend lines on, or maybe some key supply and demand zones, and I'll project them right. Then I'll do the same with the weekly, then the daily, then the 4 hour and the 1 hour. And then I will have certain levels marked up on my charts, and I will have other things written down depending on what strategies I'm using. And I'm looking for confluences, things that seem to be happening on several time frames all in one point. And often they will be occurring at demand zones or supply zones. It's spooky, but they do. So when you do your multi-time frame analysis, I call it top-down, bottom-up. So you look from the top down and then go from the bottom up, so in case you've missed anything. All right, you look for the key supply and demands zones, you look left, put on key trend lines. I use fibs as well to see if anything is coming near to or is about to be, bounce at a key fib level, maybe 61.8, 78.6. I'm looking for price action. I'm looking for trend continuation or a trend change. I ask myself that question, what has price done? What's price doing now? What could price do? And do I want to get involved? I'm looking for confluences. And also, this is really important, is this word here, context. Oops, sorry. Context. This one here. What I'm looking for is when I'm looking at, if I see a potential setup on the 4 hour or the 1 hour, okay, or even the daily, I'm looking for the context of that trade in the bigger picture. So if I'm looking at a 4 hour, 1 hour trade, am I going against the trend on the daily and the weekly, or I'm going to go with the trend on the daily and the weekly? Okay, so if I'm going against the trend, then perhaps my target, potential targets are going to be less ambitious than they were if I was going with the trend on the daily or the weekly or the monthly. Okay, so getting the context right is important. Okay, and a good way of checking that is this: before you take a trade, say if you're going to take a trade on the 1 hour, all right, I would look at the 4 hour and the daily, and I'd also look at the 15-minute. I'd look at the 4 hour and the daily to get the higher time frame context, even the weekly even, and the 15-minute I would look at that to see if I could wait and perhaps get a tighter entry. Okay, but if I'm not sure, I won't force the market, I won't chase price, okay, I will sit on my hands. So if in doubt, stay out. It's better to wait and be patient, have the patience of a saint and the discipline of a soldier. So wait and be patient and let the market bring the trade to you. Don't force the market. Lots of people will sit down and say, okay, I'm free today. It might be a Monday, it might be a Wednesday, Friday, or whatever. I'm free to trade between the hours of 10 and 1 or 6 and 8 in the evening. Okay, let's trade. Well, actually, the market might not be in a fit state to give you anything. It'll probably be in the state where it's going to take the money away from you. So the key thing is to do your analysis, set up your levels, wait for price to come to them, or trade towards those levels, okay, and then pull the trigger at the right moment when everything lines up. So you've got your risk defined, you know what profit targets you've got, you enter the trade with a stop loss, you put your take profits in as well, your orders to take profits at certain levels, and always be conservative, just come down below them slightly, and then manage the trade. And often managing the trade means not fiddling with the trade, it means letting it run. Okay. If you get to first profit target, move to break even, get to second one, trail or stop. If it keeps on going, I normally enter with 3 positions anyway. I risk 1% on total out of those 3 positions, so each position is a third of 1%. Price then continues to move, trail or stop, and I squeeze what I can out for the last one. Often though I might get the first and second profits, and then price starts to turn, and then I manage the trade and close the trade out. Okay, so that's kind of what I do in terms of using the multi-time frame analysis. But the key bit there is, context, looking for confidences. If in doubt, stay out. It's better to have one good trade a month, but a long trade over a period of time, than have lots of trades where you get stopped out all the time and your equity gets eaten into. So we've looked at supply and demand, resistance and support. So supply is where there's more sell orders than buy orders. Demand is where there's more buy orders than sell orders. So price goes up at demand, goes down at supply. This is where the institutions, big banks, and that put their orders. Okay. Supply is resistance. Support is demand. If resistance is broken, it turns into support and vice versa. So look left and stay safe before you enter a trade, rather like crossing a road. Identify those key levels, project them forward to the right. Trade to and from the key levels. Think price action. Okay, what is price doing? Higher highs, higher lows going up, lower highs, lower lows going down. Before you enter a trade, say, what has price done? What is price doing now? What could price do in the future? And do I want to get involved? The best trade may be sitting on your hands. Okay, then we also look at candlestick formations at these levels to see if we get a confirmation of reverse, and we've been through some of those, but hammers, morning stars, tweezers, railway tracks, doges, bullish and things like that. It's those price rejection candles, that's what we're looking for. And we're using multi-time frame analysis to do our top-down, bottom-up, looking at all the particular time frames. Any questions?
Hi, Martin. Thank you for that. Let's go back to David saying, yes, I've been looking at supply and demand zones myself recently. Do you spot them manually or use an indicator?
Oh, God, no. No, manually, absolutely manually. I just basically, I look left on my chart. So let's see if I can do that.
Let's go back. Ripple's asking the same thing. Do you use any indicators?
Yeah. Okay, right. So let's see if I can just do this. So, right. Okay, so if I'm going to look for supply and demand, okay, so price comes up, makes a high here, really good strong rejection. See how the price fell away sharply from that level? You've got wicks, and then price bottom just dropped like a stone. That is an excellent level. That's where institutional traders will place their orders in the future. Okay, when price came up, it didn't even get near it because people were selling it already. See how it fell away. All right. So here's one down here, so we can project this forward. So what I'm doing is I'm looking left, and I'm looking where the wicks are, and I'm looking where the candle bodies close or open here, and then I'm projecting that forward. Okay, like that. And I'll do that on my charts. Now you can end up, if you do monthly, weekly, daily, 4 hourly, 1 hourly, etc., with a chart full of all these lines and things. Okay, what you have to do is be realistic. You say to yourself, okay, so if I'm trading over here, then what levels do I need for trading over the next day or two or the week? Yeah. Well, you might just need everything that contained kind of like in this region here. Yeah, something like that. That's more than sufficient. So you mark up your chart, and as I've done here, supply resistance zone. So if price gets up to here, that could be a nice area to sell. At the moment, I've got a trend line, a big trend line on the daily here. Let's go. This is the euro, by the way. Trend line here, so price comes down the bottom here and fits in with a demand zone to the left. Here could be a buy. It comes back up to the top here, could be a sell. If it comes up here, that could be a sell. If price comes up to here, yeah, that could be a sell zone. But it's what you need for the time period that you're trading over the next week or two. And if you're looking at charts every Sunday night, Monday morning, then you can reappraise yourself on what levels you actually need on your charts. Otherwise, it can get really messy, if that makes sense. Okay. But do think of it like a ladder. Price will move up and down with these waves. Okay. And when price comes back to a level, here's the level it fell away. In fact, here's there's a level, and that's where price turned right there. Yeah. And it's a bit of an art, no doubt about it, but it's worth practicing. And the way to practice it is to go way back on your charts and say, okay, maybe here's a level. Okay, here's a level maybe where price fell away sharply there. And just see what happened to price when it got there. Okay, the first reaction, this one here, it fell away. The second one, it broke through it, then went up to the next one higher up. So if you have a level on top of a level on top of a level, then it'll tend to progress its way up, normally up the levels. This one here is where price actually went to up here, and then turn around. It had a spike higher than that. Could have been a news announcement, and then reversed completely. Okay, but you're waiting for the confirmation before you enter the trade. All right. But that's the way to learn how to see where price reacts. So there's one here. Moves away, price comes back down to it. Moves away, comes back down, low, high, higher low, higher high, higher low, higher high. So again, you've got a new uptrend starting here. So you get some confirmation around here, you can go long, trading it up to these next levels here, there, or even higher. Okay, and then go down here, take this off. Looking for, here's a level here, price fell away strongly from it. There's another one below it. And this really, it's not that technical, is it? It's pretty basic. But look how price reacts around these levels. Comes in, penetrates it, falls away. Yeah, comes back down the bottom. Here's one here. The price moved up sharply. Project it right. Where did price bounce? There. So really, it's worthwhile practicing this, and it's the fundamental. I use this for every single trading strategy I have. I'll make sure I've got a level. If I've got a strategy setting up and it's not a decent level, then I won't trade it. I'll wait for price to get to the level, and if it overlaps with my strategy, then I'll pull the trigger. Okay. But at the end of the day, do you really need the strategy? Well, actually, you've got to ask yourself. Probably not, but it helps manage your brain when you're trying to trade the hard right edge of a chart. Okay. Any other questions?
Okay. Thanks, Martin.
Okay.
Does this strategy work just with Forex, or is it something that you've seen working in other markets as well?
No, it works in all sorts of markets. So basically, if it's order flow, and the markets don't move on news. The markets don't move on trends or whatever it is. The markets are moving on order flow. Yes, there's news behind it, but it's the orders that are being placed that actually move the market. It's not the news. It's people placing the orders based perhaps on the news or on their view at the time. All right. So it's the order flow. So if you can identify where the orders are, then every single market, doesn't matter whether you're selling or buying widgets, fish food, cars, rice. I mean, candlesticks were all based on rice markets, weren't they? That's where they came from. In Japan, I think it was. So, or China or Japan. So the principle of a financial market is that it works on orders. So it works on every financial market instrument that I know. Okay. So when we were looking, so gold. Let's have a look at gold. Here we are. So this is what I was looking at gold. So gold isn't Forex. This is a different market. So this is a bit similar to what Carol had in terms of the bull flag. Okay. So the question is, where are the levels? So here's you see where the price has come up here and found resistance, and found resistance here. Project that across. Let's make it bigger. So I'm waiting at the moment for price. I've got this little green block here, yeah, to come down perhaps potentially to this region. If it pops out below that region, down to these levels here, okay. then I might be a buyer as well. That's because there could be a potential harmonic pattern here. But also, if you look at the 200 moving average, that's another thing I use, 200 moving average. So that it's moving across from a chart coming up here, we could get a confluence of things happening. So gold messes around here, then hits the 200 moving average. Financial traders throughout the world will lean on the 200 moving average. They'll lean against it. By that I mean they will start to buy if prices remains above it. Okay, and particularly if you've got a bull flag here, they might use that as a springboard to go long off as well. Okay, but essentially, I'm waiting for some decent levels. If that all breaks down, though, my next level is already highlighted here. See that? Strong move away. Price comes down to here. I'll be a buyer. All right. And then I've got to say, okay, what's the context for the trade? Well, go to the weekly. I've actually got an Elliott wave here, potential Elliott wave, so I'm looking for, in fact, that's interesting. If you go to here, where I've projected price could come down to, the weekly 200 moving average is just here as well. If it comes down there, I could be buying now. I draw a line where that wick is, so that candle, that strong move up, that's pretty much where I'm predicting perhaps price could turn down here. Okay, so I'm waiting basically on this event, and if price comes down here on gold in this region here, I'm going to start to build a position. And because I think it's an Elliott wave, I think we could go potentially up to around 1400 at least. So let's look left. If there's anything left at 1400. Let's have a look. Well, there's this previous sell-off zone here. You can project that all the way forward. There might be something up there. So that kind of fits in with my view. A nice supply zone up there. That could be a good target if we get the right setup down here. But I'm waiting patiently. It doesn't matter. I'm just going to wait until I get the right conditions. But essentially, it should be based on supply and demand. That's all it is. Okay. Yes, I add all these other different things on top of it, but they're just my comfort blankets, really. When it comes down to it, it's order flow. Yeah. Down here, price is going to be relatively cheap compared to up here. Yeah. So think that as well. Relatively cheap, relatively expensive. Is this retail price or wholesale price? There's more wholesale price down here. This is more retail price up here. So this is where the shops want to sell you their goods up here if they bought it down here. Okay.
So we're being asked, is your strategy buy support and sell resistance then?
Pretty much. Yeah, that's what it is.
Yeah.
Yeah, absolutely.
And Paul's asking, what about moving averages? Do you use?
Okay, yeah. So moving averages. So normally people will say, here's. Let's see if I can find an example. Let's go to the euro. Whoops, sorry. Charts. Let's see if I can do this. Insert. Just put some moving averages up for. I'll try to keep the things clean for you. Simple. There we go. And I'll put another one on here. Okay. I'll just put one more on it, and we're away. Insert indicators, moving average. Okay. So 100. Okay. So the standard way when you're looking at moving averages is here's a downtrend. And so the 50 is green, this is the 100, this is the 200, and this black dotted line is the 800 simple moving average. I have that as well, and I'll explain why. Normally, when your novice traders are taught about moving averages, they say, okay, if the moving averages are all in the correct order of moving averages, say the 50 is below the 100 is below the 200, in this case below the 800, okay, then we're in a downtrend. That's fair enough, and you can see it's in a downtrend, yeah, and not a problem. And when you see that, and then price pulls back into it to the 100 or the 200, yeah, then there's no reason why you couldn't sell it, yeah. But moving averages are lagging, so they're telling you what price has already done. It's not telling you what price is going to do in the future. So you could say, okay, here's a turn in the market here, all right. I'm going to sell it when it comes back to the 100. Well, if you did that, you got caught out and blown away. You're going to do it again when it comes back to the 200. Well, it carried on, you know. So you've got to be really careful with them. I personally use price action. So price action here is saying low, high, higher, low. I'm long from here. Boom. Okay. So because moving averages are lagging, I don't like them. But or away from it. You can sometimes get a bit of, if you see, say, something like a common pattern of triangle, here we go, something like that maybe, all right, where price is tightening up and the moving averages are on top of each other, it normally predicts you're going to get an explosive move out one way or the other. So that's something you can look out for with moving averages. But essentially, if price is away, has been away from the 200 moving average for a long time, it will snap back, it will correct back to it. Okay, like you see here. Okay, so the trend won't go on forever. But if you're a trend trader and you've back tested, okay, you've gone away and you've tested your strategy and you know that every time a particular currency pair price comes back to the 50 or the 100 or the 200 and then continues its trend, you know, if you looked at the higher time frame, the context might be there, then you could trade it. But I'm not a great fan. I hope that answers the question.
Thanks, Martin. Quickly, is there a typical amount of trades that you take a week?
I only trade what I see, and if there's nothing to see, I won't trade. So some weeks I might have maybe 3 trades, 4 trades, and other weeks I might have 1 or none. Doesn't matter. Because I'm primarily a swing trader, I'm looking for the right times to get into the trade. So for example, I said I'll be looking, if I saw that happening here, you know, here's another tip for you. If you see price make an M or a W, yeah, that's normally a reversal signal. It's actually a harmonic pattern here, but if you call it an M or a W, then that's pretty good.
Okay.
Here's another one here. See that W here?
Mm-hmm.
Okay. Here's one here. One. Look at them. Boom. So yeah, it's what the market's going to give me. If there's nothing there, then I won't trade it. You know. And in terms of what days do I trade on? Mondays I rarely take a trade on a Monday. Sunday and Monday I rarely take a trade. Mondays experience tells me that Mondays can be chop, and the market doesn't really settle down until Tuesday. If you've got a thing like non-farm payroll or something, it can take a few days to settle down after that. If I'm in a technical trade before a big news event, provided I'm protected, I will stay with it, and often the fundamental event will fulfill the technical setup and go to profit.
What about volume? David's asking. He says that experts seem to fall into 2 camps. Either you think it's pointless or it's essential. Which camp are you in?
Paul Wallace and I, we do a thing called the Traders Forum, and it normally happens about every 6 months. We haven't had one for a while, but we had a lady came and spoke to us about volume analysis, and it was really, really interesting about it. And I then went away after the event, and I had volume set up on my charts, and I was looking at it, and I found it a distraction, to be honest. I'm already in the trade before the volume actually started moving. So I don't tend to use it. Sometimes I might bring it up and look at it, but we can do that now. Why don't we just insert indicators, volumes, volumes. There we go. Okay, let's have a look. So, okay, so if you're a long-term swing trader on higher time frames, volume might help you if you're looking at it on a lower time frame to get into the trade. But for example, if I was interested in a long trade, this is one. Yeah, there we go. So we've got a nice demand level over here. Price has moved away from it strongly. Price comes back into it. So price comes back into it, and I'm looking to get long in here. And maybe This is on the daily. If I went down to 4 hour, it would look something different in terms of the candles. But if you look at the volume, by the time you get a noticeable, you can see the volume is rising here as we're coming into it. Yeah, so there's probably buyers coming into it. Before you get a nice paint above that sort of average sort of level around here, we're up here somewhere. Well, I'm taking profits here already. Yeah. So it doesn't really, it might say, if I look back at it after the event and say, oh, okay, that was nice, well, perhaps I'm in a nice trade now, I might want to hold my trade. That's a different matter. But in terms of using it to get into a trade, it's happened. You're seeing it after, again, it's a lagging indicator, because by the time the candle's closed and you've got a big move up, that's when you notice you've got a higher volume. So I suppose you could say here, we come to a crescendo here. Let's look at this one. Here's volume. A high volume here, and we had a reversal. But if I was trading using my supply and demand, big red candle here, go short here, don't need volume. Well, that will just tell me that perhaps it's a good trade perhaps coming up maybe, but I don't tend to use it. I know it's there, and I will look at it occasionally, but that's kind of my view.
Okay, that's fine. Thank you for that. Support and resistance. Okay, yep, just another 2 questions about recordings of this event. Yes, just to confirm, we are recording the event. I did post the YouTube link from yesterday's sessions in the chat box earlier. I'll do that again once we've said goodbye to Martin. But in the meantime, any more questions from Martin? Tell us just a little bit. You talked about the traders' forums there, Martin.
Yeah.
What do they sound like fun?
Yeah, the traders' forum it's not a large affair. It's a normally about 30 to 40 people in a room, and all levels of experience. So some people might be sort of just starting out on the road to learning how to be a trader, and other people have been trading for a long time. And what we tend to do is we'll get a guy called Kevin Barry who runs Investors Club. I don't know if you've come across Kevin Barry, good trader.
I know the name.
He normally starts off and sets the scene. So it'll be on a Saturday. And he will then look at all the different markets, the big markets that most people are interested in, from a longer-term perspective, a strategic perspective, to see what he thinks might happen. So that's kind of sets the scene, and then we will have visiting speakers who will come and talk about what they do. It could be on a strategy, it could be on their approach to trading, it could be trading psychology. Paul will normally have a slot in that, and I will normally do a slot. And people ask lots of questions. We have lunch together, afternoon session carries on, and then we all go for a beer in the evening together. That's pretty much it.
It sounds like a great day. Have you got any dates in your calendar?
There is. We're looking at one in January. It's not been firmly set, but I think it might be the 14th or something, the second weekend in January. I'm trying to get that.
January. Right. Okay. So one in the new year. And
it'll be like a kickstart of 2017. Let's come and see what's going to happen and see if we can use it to our advantage.
Sounds like a great day. But in the meantime, I know you're going to come down and speak at our Round the Clock Trader Live event as well on the 5th of November.
Yeah.
And Paul's also going to be there as well.
Yeah. And so if people want to hear anything specific, send me an email at martin@forextradinglondon.com, and I'll see if I can accommodate you. But I'm not sure what I'm going to do yet, but it may be a strategy, or it may be building on what I've done today and adding some more things in, really.
Fantastic. Great. Well, that's going to be a super day. Great. Well, Martin, thank you. Unless there's any more questions for Martin here today, I think we'll let you go and say thank you very much. Success and iceberg. People see, yes, very good slide.
If you really want to be a trader, you've got to put the hard work in. Okay, there's no golden button out there that you can push and all this money's going to come out of the cash machine. You've got to put the hard work in. You've got to gain market experience, rather like Carol was saying. And once you've got that and it all clicks into place, then you shouldn't look back. But it takes time, and it helps if you have someone to help you along the way who can guide you when they see you making perhaps errors along the way, and so you don't make the same pitfalls that perhaps they made and the mistakes that they made along the way, and they will help you to become profitable faster, which is what I do on the side now, because people ask me to help them. That's it.
Who were your mentors?
There was, my main one was Sunil Mangwani. He is a chap he works for Traders University, I think it is, in America, but he faces east, doing Asia, Middle East for them, as their kind of lead instructor over there. Basically, I just sucked everything out of his brain.
Fantastic. Well, that was good for you. How long did you sort of have him on? Was he someone that you could call on Skype, or
yeah, absolutely. Basically, he ran sessions every other day, group sessions, and he had his live room, and I went to his workshops when he came to this country. We became friends, became business partners in the end. And then he got this job and went off to do this work for Trading University, I think, in America. But anyway, yeah. So plus, what I did was, though, I didn't just use his methods. I've taken what he does, which is primarily harmonics and Elliott waves and supply and demand. I've also added onto that someone else who uses supply and demand, and I've also added onto that someone else who uses overextension in the markets, stuff like that. So kind of combine it all together and kind of overlay it all on top of each other to increase the probability of success. But if you strip it all out, it still comes back to that one key thing, which is supply and demand, order flow. The market has a memory. Use it.
Very good indeed. Well, thank you, Martin. All very clear and concise, says David. What type of returns do you make, Martin, on a monthly basis? Well,
well, that's a good question. What I would say is, if you are going to take this seriously, I will encourage my students to, one, become profitable first in a demo account, then to trade live. To trade live starting off in a reasonably small account. If it's too small, you can't manage your risk properly, and then build up their confidence. And I'm aiming for them to make around 5% a month. Okay? That's what I'm aiming for them. 5% a month.
What would you say is a reasonable sized account?
It is. What is a reasonable sized account? Okay, so if you're trading starting off, the trouble is when people start trading, they will break the rules, right? So I would say start trading off with maybe a couple of £1,000 maybe. Okay, 5,000 if you can. All right, that way that allows you to manage your risk, because I trade with 1% risk at any time, and to do that I have to alter my stop loss. So when I alter my stop loss, my position size changes. Okay, so if you haven't got the equity there to manage your position size, then you're going to come a cropper. Right, so ideally, ideally £10,000 or $10,000, yeah, ideally, because that allows you to alter your position size and trade on the higher time frames. But it's not essential. You can decide to, I'm going to trade with less positions because I have 3 positions as well. So it's up to you. But generally, at some point, if you're a novice trader, most people will blow an account up. So if you put all your money in straight away and then you blow your account up, you will come unstuck. But if you only traded small to improve your emotions of trading, because there's a psychological aspect to it, and you get used to that. But if you blow your account of $1,000 or $2,000, well, actually, you'll probably be able to reseed that if you're a prudent person. Okay, if you put your £20,000, £50,000 straight in as a novice trader, with these great expectations of making 5% a month or more, you will blow your account up. Guarantee it. Don't do it. Don't break the rules.
Well, there we are. Good lesson to leave us on, I think. So I'll say, Martin, thank you very much indeed for coming and joining us, and very good, nice, clear presentation. So we'll keep in touch. We'll look forward to seeing you, those of you that are going to make it down to London for the event on the 5th of November, the round the clock event. You'll be there, which will be great, so you can actually have a chat and
absolutely
a bit better. So
I'll leave you this. If you just see a similar screen, there's the final trade. So price action, Okay, taken a profit here. I've added to my trade here, entry here, added to trade here, both at stop loss at break even. About to come up to my second target here. Look left, supply. That's it.
Fantastic.
That's the US dollar Japanese yen 4 hour, by the way. Okay.
Easy, isn't it? Okay. Well, thank you very much indeed. We'll let you get back to the charts, let you get back to the trading,
Thank you.
and we'll speak to you again.
Do I have to make you the presenter again? Do I?
No, I'll do that off from this end.
Okay.
No problem.
Brilliant.
No problem.
Thanks, Simon.
So you can log
Okay.
out. Thanks
Have
again,
a good day.
Martin. Bye.
Bye, everybody. Bye, everybody. Thanks for listening.
There we go. Martin Walker from ForexTradingLondon.com. What a nice chap. And yes, I agree with everybody that the feedback coming in that you all enjoyed the presentation there. Clean top presentation, said Paul. Excellent, says Freddie. I agree. So we enjoyed that. And well, we're almost up to 1 o'clock, and as you can see on our screen, we've got Steve waiting. He's going to give us a bit of a market update. I know we've been looking at live charts this morning, but let's cross over to Steve Ruffley, mt4switch.com, to see what's happening in the markets. Busy day, of course, so it'll be interesting to get his view on where we are. So let me press the buttons that I need to press, and hopefully Steve will miraculously appear. Good afternoon, Steve. It's Simon here. Are you there?
Yes, I'm here, Simon. Can you hear me?
Oh, yes, loud and clear. Thank you very much indeed. So thanks for waiting there. Just on 1 o'clock. Now, been a bit of a change since we spoke to you yesterday. Woke up today to the news that the pound was careening down, and that the FTSE was actually going up.
Yeah. Well, I mean, that's as I explained in the when I was speaking yesterday, that there's nothing really to catch the pound. And what I mentioned levels of 125, 122, and below that 115. So, unfortunately, with Theresa May kind of setting in stone that Brexit is going to happen, that's one major effect that's going to hit the pound. And also now it's that nervousness now hits businesses. It hits the kind of wider economy to think, well, with Brexit is a certainty, because you see the FT. They put a post on every week. We still haven't exited Europe. The FT are still fairly convinced that it might not happen. It seems like the rest of the UK is, and Theresa May has come out and says we're going to invoke it before March, so sometime before January and the end of March, and it almost seems now that that's almost a certainty, and that's where the kind of fear hits the market. So at these new lows, very astutely the last presenter was saying about supply and demand. Well, when you're at new technical levels, it's very difficult to reassess where those longer term supply and demands are. So it's more likely that when you're in a large downtrending market, which we are in the pound against most currencies, especially the dollar, that when you hit these low levels of support, you don't see the bounce and that supply and demand come in at normal levels. It's shifted because the rules of the game have shifted. So Brexit has meant that a lot of people's medium-term, longer-term opinions might have changed. So when you naturally see low points in the market which should bounce, instead of bouncing, they break and they move to lower levels because the game has shifted. So right now, obviously, I'll go through the charts and I'll show you the kind of levels and what I was explaining about the pound, and the euro has followed suit. As I, again said about the contagion effect in Europe, the Deutsche Bank worries, etc., etc. There's nothing really for me screaming by that euro. So all that spike that we saw over the last few days and towards the close of the month last Friday have been erased. So currency-wise, the dollar's still remaining relatively strong because Janet Yellen's the only person really still talking about rate hikes. Europe and the UK are not. So it's pretty simple from that perspective. It's just, as I've always said, it's about being right at the right time. There's no point buying the pound when it's dropping like a stone. It's not going to bounce necessarily at these levels. You might have to wait a little bit lower.
Sure. Now we're looking at the your internet browser at the moment. I'm not looking at we're not seeing the chart. There we are. Fantastic.
All right, Simon. What I'll do is I'll just do. We'll try and keep it a little bit more concise. I do have a tendency to ramble on a little bit, but I think we'll try and just do like a 20-25 minute recap. Like you said, I'll try and reiterate some points I made yesterday, certainly about the pound and the euro. And again, it's always very interesting to be catching 10 minutes now of other people's presentations after years and years and years of not listening to other people. It's very interesting just to catch the last part of the roundup parts of other people's presentations. And last presenter was absolutely right. You know, some of the things he said absolutely rang true to me. That you know, you need to have a decent size account to trade. And I said this to you yesterday, and I mentioned £10,000 is probably a good amount to kind of realistically make your you know, £500 a day. And you know, above that 20 grand, 30, 40, 50 really does give you an opportunity to make some serious money. And I also agree with the point that any serious trader will blow up an account. I've blown up plenty of accounts. No, it's not something to be proud of. But again, it's when we're talking about blowing up accounts, we're talking about, you know, maybe £4,000 or £5,000, you know, maybe, you know, a £10,000 account. When you're trying to make £10,000 a day, you know, the kind of money I've made, then that's just part of the course. You know, it's part of the learning process. And you know, I have accounts now that are well into high six figures, and there are just different rules to the game when you're trading with different amounts of size. And there is the point that when you start trading, that you can start small enough and manage your risk, but that has to be, again, it has to be realistic. You know, you have to be able to change your position size. You have to be able to position your stop, not just based upon your capital, but what you're trying to achieve. But then also, you can scale it up to a certain point to, you know, what you do on £1 a point, you can do at £10 a point. That gets to a point where you can't do it. You can't do on £10 a point what you can do on £1,000 a point, what you can do on £10 a point. So different things do come in, you know, the more you scale up your trading in the market. But I guess it depends what you're trying to achieve. A lot of traders, you know, without going to an educational session here, a lot of traders don't believe there's a holy grail, and they know that trading's hard. But what they don't do is have any kind of real clear goals of what they're trying to achieve. So they put some money into an account, which is the easiest part. The easiest part of, you know, putting money into an account, anybody can do that. It's just transferring from your bank account, finding the right broker, and putting it in. The difficult part then comes with setting yourself, you know, how you want to work through the day, the week, the month. People are very, by the very nature, short-termists. And, you know, this is the problem. A lot of people can get disheartened by one trade or one bad day or one bad week. It's a marathon, not a sprint. Very much like that iceberg analogy. You know, you have to be looking 3 months, 6 months, 12 months, 2 years into the future where you'll be, because that's how long it can take people to get good at trading. I know people that have got great at trading in the first week. I know people that it's taken 6 months, a year, 2 years. Some people never get good at trading. So again, this is the whole point where this one-size-fits-all generic educational approach that you see on the internet these days doesn't really work. And that's why you have to find somebody who's been there, done it, and, you know, got the t-shirt type thing. Because it's not just the experience of them doing things wrong and seeing other people do things wrong. It's getting inside your mind. Because each trader is absolutely unique and individual. And there's so many things to interpret in the markets, from the fundamentals to the technicals, that nobody sees the markets the same. And it's really getting people to understand themselves, their fears, you know, their aspirations, their goals, etc., and how they fit into the markets. That's the real key to being a good mentor. And I've experienced very few people in my lifetime that have come anywhere close to do that for me. But I know there are people out there that have helped people, but it's not this one size fits all. It's not this that we all go through the same things. We'll go through the same things in a broad sweeping statement. We will all make money, we'll all lose money, we'll all find times in the markets. We just don't have a clue what's going on. But that's the highest level of trading. When I'm talking about what I bring to the table when I'm mentoring, I'm talking about that 1%. Now that 1% can be literally anything. It can be, as I said, setting yourself realistic, accurate goals. It can be me telling you to simply not do things, or simply you must do things if you've got any chance of trying to be, you know, a consistent trader. So these are the things, you know, that they seem tiny and insignificant at the time, but really the broad stuff is covered by everybody, you know, by books on the internet, by webinars, you know, by these DVD collections. All the basics are out there for everybody to see. That is absolutely free. You should never pay for the basics. What you need to do is find somebody who'll give you that missing 1%, and that's all it is. That's the difference between making it as a trader and not. Anyway, what do I know? Well, this is what I do know. When I was talking about the euro dollar yesterday, I said that there was no way that the euro was going to continue to spike short, medium, or long term. And I listed a number of reasons, you know, fundamentally and technically, I just didn't see the point. And when you go back to the higher time frames, a little bit of a messy chart this, you know, a lot of lines, gets very high time frame. When you're looking at the previous unprecedented 9 months of selling that we saw in the euro versus the dollar, we've consolidated towards the bottom of the range. And you tell me what's going to now bring the 1% funds, the central banks that come in and push that euro back up. Got unemployment-related figures out of Spain, back to being terrible. We've got problems again with, Greece rearing its head. Pensioners of all people, rioting in the street. These things in Europe are not by any means settled. All these rumours of Deutsche Bank, there's no smoke without fire. Do we think Deutsche Bank's the only whiter-than-white bank that's never done anything wrong? Not a chance. So again, all these little tiny cracks are starting to add up. Now Theresa May set a clear message to Europe and the UK that the Article 50 were triggered anywhere between January and the end of March. Then it becomes real, and all the implications that will come with that. I think for Europe and the especially this idea of contagion is going to be the first thing that people look at. Not really how the UK is going to deal with its exit of the European Union, how it's going to do its trade deals, but much more about how Europe's going to deal with other countries thinking, well, I don't think we're getting the best out of the European Union now. We'd like to control our borders. We'd like to talk about better trade deals. We don't necessarily want to be part of a sinking ship and allocating our resources and our money to countries that we don't necessarily align with politically, socially, economically anymore. So really, when you look at the kind of monthly to the weekly, dragging down from them higher time frames, if the euro is going to make an attempt to get back to these upper levels, I'd say probably 118, 120 is where the euro would be potentially be able to bounce from to get back to these highs. It just doesn't look like it's coming anytime soon. It doesn't look that way, fundamentally, from any reasons I've just listed off. But technically either, it doesn't really look to me like the market really wants to kind of bounce back. I mean, if you're doing a basic Fibonacci, from the high to the low, you'd expect, the 50% to be the target, so back at 122,570. Now, we haven't made a new low, which signals that, back in October 2015, that we could then be on a rise and a bit of a march to get back to that 50%, but we didn't get back to, the Fibonacci 38.2, we haven't got back to the 50%. So the longer it doesn't do what it's meant to do, and again, remember my kind of Fibonacci rules are 80% of the time, a strong directional move will retrace to 50%. Now I can show you examples of that time in, time out on every chart. But this chart is showing this strong directional move down here. It's still in play because, we've got back to the 23.6, but that key 50%, it looks just unachievable, doesn't it, through time? It just does not look like the market wants to claw back and get up to those higher levels in the euro. So what doesn't go up will go down. So its natural target is to make a new low between 105 216, and when that is hit, where's the low point? Well, it's back to parity. It's back to 1.0. Deutsche Bank, UBS, all the huge banks. Deutsche Bank at one point at the FX market and was it Deutsche Bank and UBS? I mean, they accounted for over 30% of the FX market. So when the big players say that that's going to happen, more likely than not, it does happen because it's the self-fulfilling nature of trading. So realistically, if we haven't had a reason, technically hadn't had a reason fundamentally for people to jump in and buy the euro at this low level, then it's going to continue to move lower. So for me, I cannot see any reason whatsoever for buying dips in the euro. And as we go through the dailies, again, more consolidation. I mean, you don't have to be a great chartist to draw, these kind of consolidation patterns. I mean, that's clearly, a wedge pattern is being brought. So what we're going to do is consolidate down to, these levels, maybe go a little bit higher, maybe a little bit lower. But when the breakout for me, it seems inevitable. It's on the downside, and you've got all your nice levels to target all the way down, as I said, to parity, which isn't a million miles away now by any stretch of the imagination. So I would say, realistically, it's all about understanding what you want to achieve. So that goes back to if you want to be a long-term style investor or you want to be a trader. Because for me, I don't really mind. I'm not looking to be right in my opinion. I'm looking to make money. So if I flick straight into the hourly charts, well, I just look. I look that we didn't hit that kind of weekly trend channel line here. We saw a big spike in the euro on the close of the month. So let's do a Fibonacci. So where's it going to get to? Well, it's got to pivot around that 50%, which it does. Look, all these Fibonacci's are decision points. The 23.6, 38.2, 50%. Now that acts as pure pivot resistance. So the market cannot find support on that 50%. So what's it going to do? Make a new low. So it can continue to go low, hit the bottom of the trend line here, whatever. You know, your chance to make money selling the euro high has been presented to you. You have to be fairly patient as it bobbles around, you know, these upper levels. Once it starts to break through the fibs, they're not bounce levels, they're break levels. And you just stay short until it makes a new low. So for me, I would say easily, if you look at the Fibonacci expansion, this, for what, spiked up, you know, calling 984 ticks, it could easily bob back down 600 ticks. You know, and below that you have your trend line, below that another key level, and then your 261 spot 8 retracement mark, and then below that, you know, your 423. So it becomes a self-fulfilling prophecy in some respects, that if the euro can't, on the higher time frames, bounce from the lows and find buyers, then it has to sell. So it's being right at the right time, because it's selling here and then saying, well, it's not going to go down, it's probably going to go up, and getting out, then the market, you know, then drops off. Because if you're selling it, you know, you're selling towards the bottom of the range, so they could easily bounce back up to key levels. So if you're looking to sell now, you need to be selling high, so selling back when the market bounces and takes some profit. And maybe that's already out of the market here. Maybe the profit of the low point's been taken and the down move will continue. Because I mean, this is an hourly chart. You're seeing 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 hours of selling. 1 hour of profit, that could be followed by another 11 hours of selling. This is why I find it very difficult to trade the kind of currencies in a minute, because after the summer markets leave and the liquidity kind of comes back in, you just get these algorithms and you get the markets just pushing you and pushing you and pushing you to make you think that you're wrong, and then the moves happen. They don't happen in these big spiking ways like we see previously when the markets have a little bit less liquidity. We see them do a slow grind. So if you're a short-term trader, you want to be involved here in these big candles. That's where you want to be getting short and then getting your profit out. And that's really difficult to do for an intraday trader, because it kind of pushes against all your instincts. You know, you want to be right, and you want to be right quickly. You don't want to be right and then talk yourself out of the trade, and then the market does what you think it's going to do. And that's really the toss-up between, as I've said a million times, having the right opinion and then also making money from being right. Having the right opinion means you have to hold on for an extended period of time. Being right is catching the strong directional moves in the market that happen quickly. Because, I mean, for instance, you know, the market breaks the 23.6, it gets down to the 50%. You know, let's call it 27 full ticks. But that, you know, you have to wait time for that. Whereas this break below the 61.8, you know, that's moving it on its own, you know, 18 ticks. So in that hour, you have the ability to make nearly, you know, 2/3 of that movement that's taken hours and hours and hours to come in that one candle. Now, if you're an intraday short-term scalper trader, that's where you want to be involved. And that's, again, where you have to start trading and looking at the smaller time frames, the half an hour, the 15 minutes. You want to be involved in these type of candles when they move quickly and there's lots of volume, lots of direction. And I guess I can kind of sum it up. You know, if you don't have access to charts like this, you don't have access to assimilate data very quickly, you're always going to be on the back foot. So if I'm looking for the euro to be selling down, I need to be looking at it from an intraday trader's perspective. So the daily is about as high as I'm going to go. So every time we've got high, excuse me, in the euro, we snap back down. So look at all these wicks on the high side. So that means that every time the euro is pushed up, it's been slapped back down, and the market looks, you know, consolidating for sure, but it looks more bearish than it does bullish. So then you look at your hourlies and you look for good points in time, you know, your Bollinger Bands. You know, you look at this point here, consolidation, when the Bollinger Bands are tightest. When the Bollinger Bands are tight, what do they have to do? They have to expand. So if they're going to expand, which way are they going to expand? To the downside. And then you want to be involved in your 15-minute charts. Again, and look how your Fibonacci's work. 100% retracement. Look at these levels working perfectly. You know, the market is drawn to them. So where's it going to get below this? Well, it's going to get to one spot 1160, isn't it? Because that's what it's done in the past. Held as support, broke. Held as support, broke. Held as support, break these lows, continue the trend downwards. There we go. So again, it's not about being right, but being right at the right time. So it breaks the Bollinger Band on the 15 minutes. That's when you get in and you get your 22 ticks. Because very rightly, as the previous presenter said, you know, if you're trading a £500 account, then you could probably only trade maximum £2 a point. Okay, they're not going to make enough. 22 ticks dropping down to these lower levels, even if you know it's going to happen. Even if you get all of those 22 ticks, it's not going to make you enough money to be a full-time trader. Now, if you've got £20,000 in your account, then you could probably trade £20, £30 a point. And that means if you do get them 22 ticks, you can make your £1,000, £1,500 a day in that one trade. That's the difference. If you don't have the money there, yeah, and you can't use that margin, you can't use that ability to scale in and to use size, you will not make money as a trader. Because all you're trying to do with a small account is run trades for as long as you can. And that's what fools people into thinking, they can be traders. By holding one trend for a couple of days and making a bit of money, there's not a trader make. A trader should be involved in the markets 3, 4, 5 times a day with some serious, significant, size, compared to their account and taking money. So you take 2, 3, 4, £500 out of a trade. You might take a hit, lose £300, but then you're back. You make £500. Again, you're in the markets. You're using the pace, using the liquidity. You're using what the markets are doing for you. This movement every time you see a big 5-minute candle. You should be involved like this. You should be involved. There's enough money in that one candle to make your daily target. 13.5 ticks, yeah, if you're trading good size, is enough to make your money. But then you've got to be patient. You've got to wait for these little flurries. Wait for the bounce back, wait for the Fibonacci's. So if you don't have, charts set up like this for an in-depth view, how are you realistically going to get involved in the markets consistently? You're not. I know where my support and resistance lines are because they're there on every single chart for me. I know if the euro breaks these lows and it really wants to hit hard, it's got to get down to these lower levels. 1.1303. Yeah, I know because it's the same on all my charts. They follow through. So it doesn't matter what time frame I'm looking at or what my objective is. I'm looking always at what could happen. So as soon as you flick back to the kind of more rounded view, you just pick a product that is suiting your trading needs. Again, the dollar versus the yen. The dollar's getting strong. We're well above 100. Only Janet Yellen is anywhere in the Western world is talking about putting rates up. So more demand has to come back for the dollar. So if the dollar remains strong, we know that with Brexit looming and the 31 years lows in the pound is going to drag down. If the pound drags down, the dollar goes up, and then the euro goes down against the dollar. Correlations, coefficients, easy. Look at this moving gold now. So I know gold could have a nice bounce off 1302.3. That's a good place for it to bounce. I might only make 5, 10, 15 ticks of a bounce. But that's enough if you're trading 10, 20, 30 pounds a point, above. So it broke through there now. So I know gold doesn't really have a significant place to bounce until 1284.2. So already I'm looking, well, what's going to make that gold break down? Is the dollar going to get higher? If the dollar goes higher, then that makes gold more expensive, less demand goes down. Okay, the stock markets, are they going to come back up? If they're going up, gold should be going down. So again, always looking at correlations. Where's the opportunity? Where's the money? Because you don't have to be stuck in one product. You don't necessarily just have to be a euro dollar trader or a FTSE trader. You trade anything that moves if you have the right kind of technical setup and you put in them fundamentals. They kind of reassure you what you're trying to do. Now, there's no real data out this afternoon. We've got maybe the ISM New York index coming out in an hour and 24, but after that there's nothing else. So really we've got to think this is generally a technical day based upon the fundamentals we know. The fundamentals we know coming up that are big, the election in the US, Trump versus Clinton. So we know that if Trump gets in, no Fortune 500 company has backed his campaign, so that's probably going to be bad for stocks. So we can look at that. We can look at Janet Yellen, being data dependent. We've got non-farm payroll on Friday. Will a good non-farm payroll push her into a November rate hike? Now that's going to be bad for stocks. Rates go up, stocks go down. But then should the dollar then gain traction because it's the only country giving you more bang literally for your buck? So will the dollar continue to go up if we see a good non-farm payroll, which could indicate a better chance of Janet Yellen putting rates up? So again, all these things are massively interlinked. So gold coming down, again, looking quite hard now. So we broke that 50%. So if you're looking on your smaller time frames, again, you're seeing all your levels broke through. So these are the kind of opportunities you want to be involved in, because the hourly will break through to the 15 and your 5 minutes. So we're actually a buy in gold on the short term. I mean, look at this now. This is where people are getting stopped out of trades because the market's aggressively breaking down. So as I say, all we have to do is look through our charts and not magically, based upon the market having a memory and what happened in the past, happened in the future, there's a big weekly support down here. So what I'm not going to do is start catching pianos. I'm not going to start buying gold now based upon, potential lagging biases. I'm going to wait till it hits a serious point. So if gold, in the last 2 hours, dropped off 118 ticks, nothing to say it can't move 263 ticks. And this is, again, where you have to be very, very cautious in trading, and you have to kind of be careful, because you can end up buying gold here and think, well, yeah, it's going to bounce. And maybe 9 times out of 10, because it's broken these lower levels here, that, it could get back and then bounce back up. But then you could be shot down 120 ticks more trying to hold on to a long trade down here. And sometimes you have to just say to yourself, well, I don't know. I don't understand why gold's moving down. I haven't heard any news. I haven't, heard anything, from the Fed. I've not heard anything, from a global perspective. So maybe the market's being squeezed. But what I don't want to be doing is catching pianos here. If the rest of the market found good support here and here previously, well, again, the market knows how to inflict pain and how to inflict fear, and especially in products like gold, which are heavily traded by central banks and funds, etc. So what you don't do is buying now based upon a whim. You want to be buying it down where you do see some value, and that, like I said, that might not be down until we hit levels at 1284. So I know that I don't want to be buying gold here, because it's a license to be manipulated by the big players in the markets. So straight away, we go back to our overview. So there's only really gold moving. The DAX has done nothing. If gold was moving down on big news, then it would have affected the DAX. It would have affected S&P. If gold was going down, then the S&P and DAX would be going up, as would the FTSE. If gold was hitting these lows here, then you expect some movement in the dollar to happen. We've seen no movement in the dollar. We've seen very little movement in the euro dollar and very little movement in the pound. So this is one of them moves that gold will exhibit from time to time, where it just moves out on its own, and that's purely because it'll be big players getting involved to move it. Now, as I said, it's not a precursor to any data, because the only big data we've got really is non-farm payroll. Nothing really until that point. Really got the ECB meeting on Thursday, but until the non-farm payrolls, there's no big data. So remember, if the markets don't move, then the big boys don't make any money. So there's every reason for gold to be hitting lows from my perspective, because I think it is overly priced, and we're hitting through psychological levels 1300, and I do think gold is too high currently. But again, it's not about selling gold and trying to make money over the long term. It's trying to figure out, based upon this movement, what do we do? Do we continue to sell gold and know we've got a good target on the short side that it could go here, or do we be patient, wait for it to hit these low levels, make a decision point, and wait for some short-term profit to be taken? And I say, there's more than one way to make money in the markets. And if gold's the only thing moving and nothing else is, then this is a localized move to gold. Then it's it's big boys get involved in gold. Maybe central banks. So maybe it's, again, you've got to, if you think about people that are trading billions of pounds, in an account sizes, then we've got to widen the sphere of what we're thinking. If it's just normal market activity, gold will generally move about 100 ticks. If it's something else or someone else moving it, it can move 2-3 times that. So what we don't want to get caught is holding the baby, buying at lower levels where we have no need to, and the market suddenly trading down here. So any kind of thoughts? I kind of go into a full kind of rant mode again, and kind of just keep reiterating things that I've said. But
yeah, rant on, please do. We do have some questions here. Just waiting for the right time. We'll go back. Steve, you're a cynical chap. Do you think the government prefers a weak currency to help in Brexit negotiations?
Very astute. I am a very cynical chap, and I'm even more cynical after putting it off for so long. I watched The Big Short last night, and I hate watching films like that. I like The Wolf of Wall Street because it was theatrical, it was good, Leo was good, and that's nothing really to do with trading. But watching The Big Short just shows you how cynical you have to be in the markets. And it's not just cynical that companies will do things that they know they're going to get bailed out from. It's just that the world's full of thick people. thick people just trying to get by and do stupid things for the only reason they're doing them because they're stupid. So cynical, yes. Do I think having a weak currency is going to help with negotiations? I mean, we're not really a manufacturing country, so obviously with the tourism side and the service side, maybe it does have a tiny impact. But as I said yesterday, I think that once the negotiations are underway, and they're already underway now, be under no illusions, backdoor deals have already been made. When the rest of the world sees that the UK is pretty good at making deals and looking after its own interests, the demand for the pound is going to be strong. So these low levels in the pound will not be around for very long, and they're going to bounce back. So I don't really think, no, that a weaker pound is really a strategic move. I think it's inevitability of there being nothing else in the market to pull demand for the pound back until Brexit, Article 50 is signed, and we have some clear indications of what's going to come. So, yeah, I don't think that's a major factor, no.
Okay, two questions, Ripple and Joaquin, on this subject of account size trading. Well, let's do. Joaquin says, with 30 to 40,000, one can make serious money. How much are we talking about a month? I think what do you see as serious money from a 30 to 40,000 pound account? What kind of returns? And before you maybe answer that, because I think you'll answer Ripple's question at the same time. He says, what is your view, Steve, on using a small account with higher risk to grow the account aggressively rather than sizing up the account balance to take the position size but with smaller risk? Wouldn't it be better to risk more on a small account and have the capital to refresh the account if it blows up? That way your other capital is safe until you need it. That's
both very good questions. Both very good questions. This goes back to the point I made in the beginning that every trade is different, and there are no set rules. There are a lot of set rules that the trading world likes to tell you, because if it wasn't for set rules, then people wouldn't make any money, abusing them. But I mean, let's face it. Now, very interesting. The last presenter said he uses 1% risk. Now that's what you're taught as a trader. You're taught as a beginner trader. If you Google risk or you speak to anyone, when you're starting off trading, they say trade anywhere on your account size, and your stop should be 1 or 2% of your capital. So that's easy to work out. You know where you stand, and if you do that, you won't go poor. But as the second person said, yeah, be more aggressive. If you're only doing a 1 or 2% risk stop, you won't be poor. You won't lose your capital quickly, but you might not make any money, and it might take a long time when you do to make any money. So this way, it all comes back to what I said. It's different for different people. There are no set rules when it comes to making money. However you make money is down to you and however you're comfortable with. Some people like to tick away, get the odd big win. Some people like to run bigger risks, be more aggressive, and make big wins followed in by reasonably big losers. Now, when it comes down to account size, I mean, it's fairly simple to work out. Now, if you're looking at trading the DAX, for instance, or something like InterTrader, you need £300 of margin to trade £1 of DAX. Now, if you're not trading anywhere between £3 and £10 a point, you will not make good money. It's as simple as that. You will not make good money. The amount of time you'll have to hold trades for, the amount of time and exposure you'll have to be involved in the markets is just too great. You will end up losing money. Now, people are naturally impatient. People are naturally, short-termist. So what I like to see is using anywhere between 10 and 25% of your account margin in a trade, because that's what the money's there for. The money's there to use, size at your disposal. I use averaging. I average into positions to negate my stop and to fade out movement. What I like to do is start a small position and build up 5 or 6 positions around that, to then hold my position in the market. Now, you can only do that with a big account size. Now, you can do that again with a smaller account size, but you just start with £1 a point and maybe move up to, averaged into be £10 a point. Now, if you've got a 40 grand account, you can start at £10 a point and average into probably £200 a point. All the difference is the amount of money. Now, it's very difficult to tell people how much they should be making on a £40,000 account. Now, if you have more than £5,000, £10,000 in your account, it's absolutely more than achievable to make £500 a day. But with that £500 a day, you have to do it every day. So say there's 22 trading days in the average month, you're going to be making, at least 12, 13, 14 of those days profitable, because the other days will be losses. Now, invariably, when you're trading slightly more aggressively, your stops are bigger than your winning days. So if you have 5 days winning £500, you make £2.5 grand, then it's more than likely your losing day will be 1,000 or 1,500. So net, you've only made £1,000 on the week. So that again is all trying to figure out what your win-loss ratio is, what you're going to do on an average. And you can't do it based upon what you want to make a day. You have to do it on what you're trying to make a week and a month, because a day is too short. So if you have the ability to make £500 a day, and you do that every single losses in a month, you're probably not going to make more than, be realistically here, probably £3,000. And then you've got to do that every month, 12 months of the year, to make yourself 36 grand, which is just about an average wage. So £500 a day sounds a lot, but the reality is £500 a day, coupled in with your losses, you will have the big blowout trade, because everybody has that. You just get things wrong. So net, if you're trying to make £500 a day over the space of a year, you'll be doing amazingly well if you make 36 grand. More likely, if you are profitable at all, it'll be close to 20 grand. So when you kind of put it that way, and this is with no cost, remember, you don't have any cost trading on a spread betting platform. You might have the odd charting piece of software, you might have the odd, kind of expense, as in, a squawk system, etc., etc. But if you're doing all that time, all that effort and that preparation to make 20 grand a year, it's probably not worth it. So on a £40,000 a year, you can make, I would say, £2,000 a day quite easily. And you can do that in a number of probably between 3 and 8 trades a day. Now, £2,000 gets a bit more interesting, because £2,000 a day, when you go on good runs, suddenly you're adding substantial amounts of money to your account. As you get more money in your account, you have more leverage, you have more ability to run bigger positions. So it's trying to find those waves and those runs of the up point, which really add to your account and add to your confidence. Because if you can make £2,000 a day, based upon the same kind of ratios, you could make, so £2,000 a day, 40 grand a month, then you take the odd big hit, you might be making £15,000 a month. Now that all of a sudden, that's exciting. That's big money, that's real. £3,000, not that exciting. £15,000, exciting. So again, it's trying to figure out how you get to that realistic ability with your size to make a good amount of money a day, but then make that into a weekly plan, make that into a monthly plan, because as we've million phrases that have been stolen off me over the years, one trade should be able to make you, but it shouldn't be able to break you. And it's finding that balance between how much you can make a day, and I mean, when I make a day, I mean consistently. Right, we can all stick £50 a point on, close our eyes, and let it run for 20 minutes and take 2 grand out. If you can make £2,000 a day, and you can do that off £20 a point, you can do it off £500 a point. It doesn't make any difference as long as your account size and your risk-reward appetite can be matched and balanced. You can make that money. But unless you're making between £1,000 and £2,000 a day, the idea of having a trading career and making a living out of trading just isn't feasible. And that's why it's difficult. That's why a lot of beginner traders don't make any money in trading. And that's why, whatever stat you read, 95% of people never take money out of the trading account. Because if you're not thinking big enough, the markets are so complex, so expensive, and it costs so much to be involved in trading, as in time versus, the money you make, then, you're never going to make real money. So this is why when, I do these presentations and I offer my mentoring services, unless you're going to rock up to me with 20, 30 grand, there ain't no point. I can't help you. If you've got a £1,000 trading account, all you can do is spend your own time doing everything you can to be consistent and then try and scale it up yourself. You will not be able to make a living from trading if you don't have substantial capital in your account. The reason why most small businesses fail because they're undercapitalized. So all you're doing is investing in yourself. It doesn't mean that you put 30, 40 grand in an account, you're risking 30, 40 grand every time. But you have to have that ability to manage your trade size and stops outside of this 1 or 2% risk parameter. Because if you know that, then every hedge fund manager, every big trader in the world knows that if they move the market more in a 15-minute candle, more than 1 or 2%, that 99% of retail traders are getting out. So all they're doing in the markets is shifting things up and down every single day, taking retail money. That's all they do. So it's kind of a long-winded way of going around it, but again, I'm always just trying to be honest with people that trading is a very, very time-intensive, expensive activity, and if you're trying to make an actual living out of it, you have to be thinking big numbers. Now, you don't have to have millions of pounds in an account or even hundreds of thousands, but you need to have tens of thousands of pounds in an account to be able to deal with the inevitable big loss, with be able to shift your position size and your stops without being bullied into being stopped out by this 1 or 2% rule, and that's just the reality of it. So, at the end of the day, if you're trying to be a consistently profitable trader, that initial investment is almost the opposite of what most people tell you. Most people tell you put an amount of money in the account you can afford to lose. Nonsense. Because once you've done that, you've already lost that money. And it's generally not a lot of money anyway. It's generally £500 or £1,000. So you're setting yourself up to fail before you start. If you want to do that, say, well, I'm going to put £10,000 in the account, but I'm only willing to lose 2. And that's your introduction to trading. Because you certainly don't want to lose 10, and it'll make that £2,000 in the grand scheme mean something. Rather than just putting £2,000 in the account, blow it up, put another 2 in, blow it up, and that's where you'll get in the habit of losing before you even start. Okay, so that's probably my top tip of the day.
What about, thank you, Steve. Okay, just a couple of final questions, I think, and then we'll keep you. The levels on your charts, what do they signify? The W1, R1, D1, D2, etc.
Okay, well, I mean, going back to what other people tell you, at the end of the day is I know a lot of my studies revolve around things like Fibonacci. So Fibonacci works for me because I can use something that's happened in the past to predict the future. So all my lines on my charts are based upon previous levels of interest. So what's happened on the higher time frames, monthly, weekly, daily, filter through to my charts. So I know if in the S&P 500, for instance, if we break this daily level here, support 3, we'll get down to daily level support 2. Below that, more Fibonacci's, more daily levels, a really big weekly level down at 2137. So it's all time frame trading. It's looking at the charts at all time on all time frames to figure out what the market's been in the past, so where it can go in the future. And that's a combination of complicated studies. I can't tell you exactly how I come up with my lines because I've got my own IP, but I mean, it's to do with Fibonacci, it's to do with Elliott wave, it's to do with kind of significant pivots, significant higher time frame activity, and it just means you're prepared. So I can look at any chart, any chart on any time frame, and I know where it's been in the past, and I can use that to either let the market be drawn down to it or break through, and that's just what trading is. So all my lines are determined upon what happened in the past to predict the future, and the green and red lines of the Fibonacci, they move with the market. So as the markets make a significant move in one direction, the Fibonacci lines recalibrate, so you can then have an idea of what's happening in the here and now. So it's a combination of using what happened in the past, merging that with actual real-time movement, and then you figure out where value is. It took a long time to develop, and it looks very simple, but the best things usually are. So the whole point is, if you want to be, part of my group and want to be mentored, then you can get my software. If you trade an MT4, you can have a setup just like this, because if you're setting up your charts every day and spending 20 minutes, an hour, half an hour, setting them up, you're just wasting time. The whole point of automation is not to make you a better trader, it's to make you a time saver, to give you an opportunity to not spend time setting up charts, figuring out where support and resistance levels are. It's to be a trader, and that's what systems like this do.
Steve, I've put the link in, actually, just leading on from what you're saying about mentorship programs. I know you do that. You have that facility through the mt4switch.com website. So people have got that link in the chat box if you want to go ahead and see how you can do that. I think basically what you're offering, Steve, is a period of mentorship. If you're serious about trading and you open an account through InterTrader, then you have access to you. Is that?
That's it exactly, Simon. Again, I do these things for different reasons. I'm trying to give something back, but also it's quite a selfish reason. I keep sharp as a trader by speaking to traders every day that are going through different things. So if you're willing to put some money in the account and you're serious about being a trader and you're serious about making it, then I've been honest with you. I know what I need from you. I need you to put a level of money in the account which is going to buy you some time, buy you some margin, and buy the ability for you to make money, then I will help you with free charts like this, so you know what I see, and I will help you with my experience, my time. I've taught over 1,000 traders. I've mentored, beginner traders to, hedge fund managers. It doesn't really matter to me. I can get to the bottom of traders' problems much faster than the most. And again, it just comes coming from doing these things, for years and years and years. 15 years. It's been a long time. But as I said, the main criteria for me is if you're serious about making money. That's what I want to see. I want to see people that want to make money. People that are serious about getting involved in the markets, being profitable, rather than being right. Yeah, it's not about being right here and sitting here and watching a trend for 3 weeks. It's about making money. So if you want to make money, you're excited by making thousands of pounds a day, then that is there. I've helped countless people do that. But as I say, you have to be serious if you want to do it.
Okay, now we're starting to get some questions coming in on about the specifics of that. I think rather than us all talking about it now, the best thing is to go to the MT4 site, the mt4switch.com site.
Yeah, the MT4 switch site, kind of gives you an overview. But the best thing is just to speak to me. Everyone's different, as I say, and everybody's different. Everyone's different in the requirements. So just email me. You can email me through the MT4 Switch site, but I mean, it's I've got a million email, Steve Ruffley at gmail.com or sruffley at TraderMaker.com, Steve at iviewcharts.com. I mean, if you just Google Steve Ruffley, there's 1,000,001 ways to contact me. But if you just go to MT4 Switch, there is a form you can actually just talk to me directly.
Yeah, I think that's better there than we let people go, because we've had again 45 minutes, which has been great. I'm conscious you've got other classes and other engagements as well today. So, Steve, Ruffley, thank you, and you're able to come back tomorrow for another.
Yep, I'll be back tomorrow, and then we'll do one on Friday pre non-farm payrolls. Yeah,
we'll do that pre at 12 o'clock. That'd be fantastic. Great, thank you, Steve, and thank you everybody who's been attending. A rather shorter day today, as I said, but back again tomorrow morning starting at 11 o'clock with Adrian at Trend Signal, and then that will be a 90-minute webinar. So hopefully you can join us again in the morning. Thanks again for your time today. Hope you've enjoyed it. Many thanks.